That's it. Bharat sir, are you there? Hmm? Bharat sir, can we start the session? Bharat sir, you are there?
Yes, sorry, I got logged out, so I had to rejoin. Am I audible now?
Yes, sir.
Okay.
Sir.
So yeah, we are ready. If you guys are ready, we can start.
Yes. Just give us a couple of minutes to
Sure.
formally introduce you with the gathering. So yeah. Investors should purchase stocks like they are purchasing groceries as if they are on sale. So that is the right time to purchase groceries. And it is rightly said by Jim Burton that data will talk to you if you are ready to listen. Very good morning to all of you present here. I, Deepti Shastri Gupta, along with my fellow colleagues, Dr. Mansi Kukreja and Dr. Neha Sahu, are feeling overwhelmed and privileged at the same time in welcoming Dr. Bharat Kulkarni as a resource person for today in this STTP on financial analytics organized by IBMR IPS Academy Indore. IBMR IPS Academy welcomes you, sir. To begin the program, first I would like to introduce our resource person for the day with the participants. So, beginning with Dr. Bharat Kulkarni is a founding director of Stalwart Management Consultancy Services. It's a consulting firm. He is working in the field of policy advisory and development of structured finance. He has worked for about decades on various value chain development projects and structured markets initiative in frontier economics. His special area of interest is the development of agri-finance sector and has been working on various projects of establishments of financial exchanges. He has also worked for various intergovernmental agencies like United Nations Development Program, World Bank Group, and many others. He is highly sought after speaker in the field of investments, especially in frontier economics. And also he's a regular speaker for various forums like World Investment Forum, Global Commodity Forum, and of course at Harvard Business School. He is a national chairman of Indo-Global SME Chamber and as well as state president for Maharashtra for MSMEs, CIM SMEs. So from the entire IPS Academy and STTP organizing committee, We welcome Dr. Bharat Kulkarni.
Thank you, madam, for that elaborate introduction, and and thank you, IBMR, for giving this opportunity. This is an excellent opportunity to talk to you about derivatives. What we'll be doing about is in the next say 3 hours or so, we'll be talking about derivatives. What are derivatives, specifically futures? What does futures mean? How does these futures are analyzed? What is the mechanics of these futures? And then we'll go into advanced concepts like how do you actually do pricing of futures? How do you make strategies of trading in futures? And how do you actually, at the end of the day, how do you actually make money out of futures? So that's the agenda for today. As the program suggests, we have divided this session into 2 parts. The first part would be where we would be talking about the mechanics and the basics about future, and then there will be talking about the more advanced concepts. So with that, let me just start the session. Ma'am, can you give me the sharing right so that I can share the
already given, sir. You can share, please.
I think you'll have to give it again because it says host has disabled participant screen sharing. So by the time that happens, let's talk about derivatives. What derivatives are? So derivatives are actually a structured finance mechanism where we, yeah. So that's there. Yeah. So the presentation is visible now. Yeah. So so let's talk about, we'll be talking about the derivative, say commodities, into the commodity derivatives in this session, and what exactly these derivatives are, what exactly are the concepts around derivatives, what all things we look into derivatives. So this session, the agenda will be understanding about forwards and futures, what forwards mean, what futures mean, how do they differentiate, how do we differentiate between the two, what are the understandings, what are the exchange traded futures. We'll understand the basics around that. Then we'll move into more complex topic like the mechanics of futures, how the payoffs of futures happen, how the pricing of futures happen, and something about an interesting concept of open interest and volumes. So that we will cover in next 1.5 hours. And then in the next session, we'll move into more advanced concept of strategies. So with that, let me just start. What exactly is the nature of derivative? What is a derivative? So a derivative is an instrument whose value depends on the value of more basic underlying variables. So like if I go and buy a stock, or I go and buy an say gold, or I go and buy any commodity, for example, any pulses, I pay for the commodity itself, or the asset itself. Now, when I'm buying a stock, I get a stock. But then there are rights that can be derived out of that transaction. For example, I can actually buy a right to receive that commodity at a later date. So what actually I'm buying, am I getting the commodity right now? No, I'll be getting the commodity at a later date. So what am I getting it now? What am I paying for now? I am paying for the right to receive that commodity. So where does that right get created from? That right gets created from the asset, that is the stock. Suppose I come to you and I say, okay, I'll buy say a stock from you. Maybe say let's take an example of Tata Motors. I'll buy Tata Motors from you after 3 months. So that means I am actually getting a right to buy from you, and you are getting an obligation to sell to me. You are actually selling an obligation. I am buying a right, you are selling an obligation. That's the transaction happening today. This transaction which actually materialize into physical trade at a later date. So an agreement to execute a physical trade is entered into today, and that is called as a derivative. So it is called derivative because it derives its value from an existing asset. So how much do I pay to you? How much is the right to buy valuable? That depends on multiple factors, like what is the price of the share today, what is the expectation about it tomorrow, what is say the economic situations, whole lot of things. So all those whole lot of things would define how much my right is valuable. And that is what is called as a derivative contract. Now, in derivative contract, what you actually trade, you trade in rights and obligations. A party receives a right, another party is under an obligation and to execute a trade, and that trade is executed at a later date. And that is what we define as a derivative. So where does the derivative derive its value? It derives its value from an underlying asset. If there is no Tata Motor share, there is no value of this contract. Okay, so the underlying asset defines the value of the derivative contract. And what are these underlying assets? These underlying, we call it underlying variables or underlying assets. This can be an equity. We can agree to buy or sell an equity at a later date. So equity is an underlying asset. Then you have a commodity. For example, gold. I go to an say jeweler and say I'll buy say 100 grams of gold after 1 month. Now that is after 1 month, what is going to happen about the price of the gold? What is going to be the situation of gold price, demand? All those factors would define, and he'll say, okay, I'll sell you after 1 month at a certain price, and that's the value of the contract, which is deriving out of the commodity, which is gold. So you have an underlying commodity, which is gold. Then you have interest rates. So interest rates are another category of derivatives which are traded. Interest rate derivatives are quite common right now. A lot of banks get into interest rate, interbanking transactions happen on interest rates and interest rate trades. Interest rate swaps are there. So a whole lot of structured finance contracts are created out of interest rates. Then you have foreign exchange. So suppose you are expecting to receive a foreign currency transfer in about 3 months from now, and you want to fix up the price of the exchange rate. Then you can actually go and sell the foreign currency before it is actually received and agree upon a price. That is a foreign currency derivatives. Traditionally, foreign currency derivatives have been traded on interbank markets, where banks between themselves agree to buy and sell at a predefined rate. In the modern times, this asset class or this commodity is also traded on commodity derivative exchanges. So we have a lot of say currency futures contract that are getting traded. Then weather indexes. This is a new concept, not so new, still about 15 years old, close to 20 years old, in fact. This weather indexes are indexes because weather, creates an economic implication. So whether a good weather or a bad weather can actually have an impact on the economic activities in a country, especially a country like India, which is dependent on agriculture, and agriculture is dependent on weather. A good weather or a good monsoon actually defines a lot of economic activities. So weather indexes have been created where the heat index or the index related to the winters, or the temperature indexes are there, rainfall indexes are there. These indexes actually are monetized in the sense that they are pegged to a monetary value. Now, how does this affect? If you have a lot of heat, what happens? Countries like Saudi Arabia, or countries like Middle Eastern countries, or the North African countries, where the heat impact is very high, you have more energy consumption, simply because there is an increased use of air conditioners and the cooling facilities and the various facilities related to that. So the efficiencies of machines goes down, because of which the energy consumptions are high. So the higher the heat or higher the temperature, higher the energy consumption. What happens indirectly? The sale of electricity becomes higher. So you can actually peg these two and create a monetized index, where the impact of weather can be looked into in a monetary aspect and said, okay, a weather index going by a certain percentage actually has a monetary impact of this much, and that is the value of the weather index. And this weather index, based on the anticipation of the weather, can actually be traded on the exchanges. So there are various type of underlying variables. You have equity, you have commodity, interest rate, foreign exchange, anything that can be standardized or that can be monetized. A monetary value, a structured monetary value can be defined for the product or for the asset, can be traded on a commodity exchange. That's as basic as that. So you don't have to limit yourself to these 4 or 5 categories that I have said. There can be many more categories that can come up. That can be many more categories. We are talking about in a country like Ethiopia, which is an African country where there is the largest African population of livestock. We are talking about a livestock exchange. So where futures would be traded on livestock. Now, one might say it's a part of commodity. Yes, it is. But livestock is another asset class. So anything that can be monetized, a standard monetary value can be assigned to an asset class, and which is tradable in the market can actually be traded in a derivative market as well. So that's where the underlying variables are. That's our different types of underlying variables we have. Now, moving forward, let's take some examples of derivatives. There are forward contracts. Now, forward contracts are very, very basic contracts. How does forward contract emerge from a spot contract? Let's differentiate between a spot contract and a forward contract for that matter. You go to a shop, you pay, you decide to buy some, say, grocery. Let's take an example of grocery. You go to the grocery shop and you say, okay, I want this you give him the list of the grocery items. He gives you the items. You pay him the money. You take the commodity or you take the grocery, come back home. Simple transaction. What has happened? The delivery of the money, the exchange of the goods. Basically, when you give the list to the buyer, he gives you the price, he gives you everything. The terms of trade are defined. You pay the money, you receive the goods. Now that is the execution of the trade. So the agreement on the trade and the execution of the trade is simultaneous. So you go, decide, identify the commodity, identify the product, identify the asset, pay the money, receive the product. That is spot contract. That is defined as the spot contract, where the trade is executed immediately to the agreement of the terms. Just to make it more simple, you go to a vegetable vendor, a sabji wala, and you say, how much is aloo kitne ka diya? And he says, okay, 20 rupees a kg. I'm not sure about the prices right now, but that's my example. So he says 20 rupees kg. You say, no, this is too much. I'll pay you 18. He says, okay, 18 is agreed. You say, okay, give me 5 kgs. Now, what is this happening? This is actually terms of the trade getting defined. What is the then you select the alus or you select the potatoes. This is the potato, not too big, not too small, all those things. And then you say, okay, this is my asset. So you have identified the terms of the trade. You have agreed upon all the terms of the trade. What would be the price? What would be the quality? What would be the quantity? Everything is agreed upon. Now this is done. Now what happens? After everything is done, he identifies, he takes the product, gives it to you, you pay the money. This is the execution of the trade. Just imagine you identify all that thing and then you are going on a walk and you say, okay, you keep this aside. After 1 hour, I'll come and pay you and take the commodity. Now, what you are doing? You are delaying the execution of the trade by 1 hour, which you don't want to carry 5 kgs of potatoes with you on your walk. So you tell him, I'll give you after. Now, this is the time when you are actually segregating the actual terms of trade, agreement on the terms of trade, and the execution of the trade. Now, this can actually go into number of days. So you say, okay, I have identified this, but I will take it after 2 days, after 3 days, after 5 days, after 7 days, after 10 days, after 1 month, after 2 months, after 3 months, after 1 year. So now, depending on how much the perishability is important, because in case of potatoes, the perishability is maybe 1, 2, 3, 4 days. Beyond that, you cannot delay. But if it is like a gold, you go to a jeweler and you identify the gold, you identify the jewelry, and you say, okay, I don't want to keep this jewelry in my home and risk my life. So what I'll do is, I need this jewelry during the wedding. So I'll just buy the jewelry. I have identified, we have agreed upon the price, everything is fixed upon. I will give you the money and you will give me the jewelry. After 1 month, you keep it in your safe. What is that? That is an agreement to execute or exchange the delivery at a later date. And that is what we call as forward contract. So what you are doing, you are agreeing upon the terms of the trade today, but executing the trade at a later date. And that is a forward contract. Why? Because you are agreeing upon the terms in forward, for a forward deal. So that's what we define as a forward contract. Then the same thing can actually be structured through an exchange. So forward contract is what? It's an agreement between two parties to execute a trade at a later date. The terms of the trade are agreed upon today at a later date. Now, just let's go back to this example of the jeweler. So when you tell the jeweler, I will not buy it today, but I will take the delivery after 2 months, the jeweler would say, maybe the price of since you're giving me the money after 2 months, the price of the gold may actually go up. So I will not sell you at this price, but after 2 months, if you want to buy, I'll sell you at a higher price or maybe at a lower price. It depends on the situation. So let's assume that the prices are expected to go up. You say, okay, I will not give you at say 50,000 rupees per 10 grams. I'll give you at 51,000 rupees. So what is happening? The price expectation on a later date is identified, and the terms of the trade define that price expectation. You say, okay, you are anticipating the prices to go up furthermore. You say 51,000 is okay, agreed. Now on the desired date, what will happen? You will go to the jeweler's shop, pay him 51,000, take the gold, come back home, transaction completed. That is called as the settlement of the trade. So you agree upon the trade and you settle the trade. There is a time lag between agreement and settlement. That is called as a forward contract. But then what can happen is, and this is just for example purposes, suppose for some reason the wedding is put on, maybe the corona breakout causes the wedding to be put off by another year. So what you'll say, you don't need the product now. You want to exit the situation. You say, no, now I don't want to continue with this situation. I will forget it. Now what will happen? You will forget about the jeweler, you'll forget about the price, you'll forget about everything. The jeweler will keep the goods for you, but on the say agreed date, you don't turn up, he calls you, don't pick up the call, and the transaction is over. Now what has happened here? The risk of default is always there. This is a default. Okay, you agreed upon a contract and you don't execute it. Same way it can happen other way around. The jeweler realizes the price has gone up significantly, and now 51,000 is not something that he would be ready to sell. What he will do? He will not pick up your call. When you come to the shop, he will deny that, oh, we ever had an agreement like this. And what he'll say, no, now the prices have gone up. You have to buy at a new price. There's a default from the jeweler's side. So this is called as a default risk. Why this default can happen? Because there is no mechanism to risk manage the agreement. There is a risk in the agreement because the prices can move upwards, prices can move downwards. One party would always be at a benefit, the other party would always be at a loss. Prices can move anywhere. If the prices go in your favor, you are at benefit and the other party is at loss. If the prices move against you, you are at loss and the other party is at benefit. So then this keeps on building up in a forward contract. Because in a forward contract, it is a one-to-one contract. It is between two parties themselves. Okay. So that is now if you actually go into a trade where there is a third party monitoring it, that is called as a futures contract. And we'll talk about it in more detail when we talk about the exchange concept. So that's the forward and the future. Then you have options. Options are slightly different than futures or forwards. In forwards and futures, what is there? Both the parties are under the obligation and a right. See, when I agree to buy from you, what is my right? I have the right to receive the goods from you. And what is my obligation? My obligation is to pay you money. What is your right? Your right is to receive the money and obligation is to give me the goods. Now that is the right and obligation coupled together. Now if I say, if I want, I will buy. If I don't want, I won't buy. What does that contract mean? That if I want, I have the right to receive the goods. But if I don't want, I'm not under an obligation to pay you. I have a right against you, but you don't have a right against me in the trade. And that is called as an option contract. Obviously, nobody is going to be under a situation where the other party decides what to do, because if it is in their benefit, they would do. If it is not in their benefit, they would not do, unless and until they're sufficiently compensated. So for me to give you a right to buy from me or not to buy from me, depending on the market situation, I would charge you a price of giving you that right. And that is called as option premium. Now, just putting it in context, all of us have heard about this last 100 days. We have heard about this MSP concept. The MSP, there's a lot of debate happening around MSP. What is an MSP? MSP is an agreement by the government or a promise by the government that they would buy a commodity from a farmer at a pre-specified price. Is the farmer obligated to sell it to the government? No. Is the government obligated to buy it from the farmer? Yes. So who is under the obligation? The government. Who is under the right? The farmer. If farmer is getting a better price outside, he would say, forget about MSP. I'm not selling it to the government. I'm buying it. I'm selling it to somebody else. He has the right to do that. But if farmer says, no, I'm not getting a better price outside, now you have to buy from me, the government is obligated to buy. That's an option contract. It's a very, very simple example of an option contract. Okay. And then there are structured finance things which are called a swap. Swap basically means exchange. So my responsibility becomes your responsibility and your responsibility becomes my responsibility. This is used to bring down the interest rate costs in the international markets. So when I can borrow from an international market at a certain rate, I then exchange my, and you can borrow in a certain rate, you have a benefit in that, and I have a benefit in my trade. Then we exchange our obligations so that my benefit is transferred to you and your benefit is transferred to me. That's called as a swap transaction. So let's understand them in detail. So as I said, derivative markets can be, these four type of trades can happen either on an exchange or they can happen over the counter. Now, what is the difference between an exchange traded and over the counter exchange or over the counter trade? Over the counter trade means a trade which takes place between two individuals, two parties, based on their own definition of terms. It is like over the counter. It's like you go to a counter, you agree upon the price, you agree upon the terms, and the execution of the trade happens. That is over the counter trade. But then there are trades which are monitored and managed by trade bodies. These trade bodies are called as the exchanges. And these exchanges give the terms of the trade. They say, okay, if you want to participate on our platform, these are the terms, except price and the quantity, everything else is pre-specified. What does pre-specification mean? So if you go to a supermarket, for example, you find various products. Now each product has its own peculiar thing. Like if you actually buy say the sugar from Madura as a company, you know what exactly that product is. You know how much would be the quantity, how much the pack size, what would be the calorie value, what would be the size of the grain, everything is known. So that is a standardized product. Anybody who wants to trade has to trade based on that standardized product only. So that is an exchange traded product where the product is standardized. Anybody and everybody who wants to trade trades on the same terms of trade. In an over the counter market, you and the counterparty define the terms of the trade. So I'll just give you an example. When I go to the sabjiwala, say near my house, I see the sabjiwala having a big basket of potatoes, and then I can pick my potatoes, I can agree upon the price, I can negotiate him with the price, everything is done. And then I buy it. That is over the counter. But I go to a supermarket, there's a pre-packed say packet of potatoes that is kept on the shelf. I just pick it up. They may be big, they may be small. Somebody else has packed it for me. Somebody else has defined, you want to buy it, this is 18 rupees per kilo, buy it or keep it. Now that is a standardized contract, which is called as an exchange traded contract. Anybody who wants to buy has the same offering. So that is an exchange traded contract. So we have derivatives traded on exchanges and we have derivatives traded on the over the counter. Now, why do people use derivatives? Why do we use derivatives? We use derivatives to hedge the risk. That is, hedge the risk is basically transfer the risk from one party to another or reduce your risk. Okay. So if I am expecting a price to go up and you are expecting the price to fall, then what we do, we agree upon a price which you feel would be the right price and I feel would be the right price. And that would mean that both of us actually try to avoid the risk. At the end of the day, one of the party would actually be benefiting, one of the party would actually be say losing. Suppose we agree upon a price of gold at say 51,000 rupees per 10 grams. I am the buyer and you are the seller. So I have to pay 51,000 to you and you have to give me the gold. If the prices go up, I benefit because I have able to predict the movement of the price correctly and reduce my risk of price going up. If the prices fall, you benefit because at the end of the day, you have been able to protect the yourself from the falling of the price, and that is where you have hedged your risk. Hedge basically is putting a border or boundary. and that is to your loss. When you arrest your loss by putting a boundary to it, that maximum loss cannot go beyond this level, that is called as the hedging of risk. So to hedge the risk, you do. Now, who are the participants in hedging the risk? Participants who want to reduce the risk and have opposite of ideas about the market. Risk coming from opposite sides can be hedged by a hedging transaction. So I am at risk because the prices may fall. You are at risk because the prices may rise, and both of us get into an agreement. So I reduce the risk by falling prices. You reduce the risk by rising prices, and that is the hedging. Then to speculate, take a direction on the future market. Not everybody in the market is a hedger. Some people want to benefit out of the movement of the market. So what I say, I am of a very strong opinion that the prices of gold would go up. So what will I do? I'll buy today so that when the prices go up, I sell it and make profit out of it. That is speculation. Okay. Now, speculation many times is considered as a wrong word in derivative markets, that speculative profits. But in my opinion, speculation is desirable. Manipulation should be avoided. Speculation is something where people take positions in the market based on publicly known facts and their assessment of the future direction of the price based on the publicly available information. So if I am taking a risk based on my understanding about the movement of the price, that is speculation. But if I'm making the market move to my advantage, that is manipulation. I am floating say irrelevant news in the market. I am floating some facts in the market which are not true. This is manipulation. So manipulation has to be avoided. Speculation is welcome in the market. Lock and arbitrage profit. Suppose you have the physical asset today, the price of physical asset is expected to grow high, and what you do, you can actually sell the physical asset today, buy it the later date. You can make that arbitrage profit. Arbitrage profit is basically profit between two periods, two price points, to be very precise. So it can be two price points related to two different timings, spot and futures. Suppose I am a jeweler, and I am looking at the market and I am saying probably the way market is, the market is going to go down. So what I do, I sell my gold today, but to maintain the inventory, I replace it by buying it at a later date at a cheaper price. Suppose the current price is 50,000 and the future price is 49,000. I'll sell it at 50,000 and buy it in a future at 49,000, making a profit of 1,000. Or if I say I receive the product, I see the gold today and the prices are going to go up, I'll buy the gold today, keep it with me and deliver it at a later date at a higher price. That is arbitrage profit. So these are the three objectives for which you take derivatives. Then you also take derivatives to change the nature of the investment without incurring any selling cost on the portfolio. So for example, if you have say let's take the example of say Renuka Sugars. Now Renuka Sugars is a publicly listed company, and the profit of Renuka Sugar depends on how much is the price of the sugar. So if the price of the sugar goes up, Renuka Sugar makes profit. If the price of the sugar goes down, Renuka Sugar makes loss. That's a very basic say idea. Now what your portfolio has Renuka Sugar. You want to reduce the risk exposure of Renuka Sugars in the market because of the pricing. So what do? You go short, you sell the futures on the sugar. What will that mean? That if Renuka Sugar, if the prices of the sugar goes up, you make profit on Renuka Sugar. And if the prices of the sugar goes down, you make profit on the futures of the sugar. And in any case, your portfolio value is more or less stable. So to change the value of the portfolio, you can actually use the investment, you can actually use investments into derivatives. So that is why the commodity and this equity say markets have started to align together, because a lot of companies who are listed on stock exchanges actually have their exposures in the commodity markets, and people complement the positions or their portfolios in the equity market with a countervailing portfolio in the commodity market, so that the risk of the commodity exposure of the company is reduced by the expected profit from the commodity market. So that is how you can change the nature of the portfolio. Going forward, let's talk in detail about the forward contract. As I explained, forward contract is a contract to execute a trade at a later date. So there is spot. When the delivery aspect of the spot or the settlement aspect of the spot is delayed for a later date, that becomes a forward contract. Now, forwards are normally traded over the counter. They are agreed between the parties and executed between the parties without any third party intervention, without any observation of the third party, without any regulation from the third party. So that is then over the counter market. And forward contracts are mostly specifically traded in currencies and interest rates. Now you see currency markets being exchange traded, but traditionally banks, the interbank treasury transactions are all forward contracts. So how do they happen? They pick up a call, they say, okay, a bank in America would call a bank in London, and they'll say, okay, the dollar, what is the dollar pound rate? They said, this is the dollar pound rate. Okay, agreed upon, transaction done. So that is how the transactions are done. It is more done on phone calls. It is more done on, say, generally it is done on phone calls. Now you have electronic medias, and through electronic medias, emails, and through electronic data exchange, these trades can happen. But it is the important aspect is it is one-to-one. So forward contracts have been, say, banned in India. The forward contracts are not allowed to be traded in India, simply because the forward contracts have higher risk, and forwards are regulated in India. And because they are regulated, they come under the category of futures. So that is the situation in India. Now, how does a forward price come up? What is a forward price? Forward price is the contract, is the price at which both the parties to undertake a trade. I go to the sabji wala and I say, I'll buy the potatoes, but I'll come back after say 1 hour and buy. Or I go to the jeweler and say, I'll agree upon the, we'll agree upon the design of the jewelry, we'll agree upon the content of the gold, we'll agree upon the price also. But I will take the delivery and pay you after 1 month or 2 months or 5 months. So the price at which this trade is going to be executed on the settlement day, not today, on the settlement day, is agreed today. And that is called as a forward price. How do we calculate the forward price is a separate part of discussion which we'll have, but this is what we call as the forward price. Forward price may be different contracts for different maturities. Maturity is the settlement time. So it can be a 1 month period, it can be a 2 month period, it can be a 3 month period, whatever. So whatever is the delivery time. Now just imagine if I go to a jeweler and say, I'll pay you the today's price after 1 month, after 2 months, after 3 months. Would the jeweler be ready to sell the gold to me at the same price after 1 month, 2 months, and 3 months? Would the 1 month, 2 month, 3 month delay prices be same? No, because there are multiple factors that affect the price movement. On a daily basis, the prices move. Just imagine if I go to the petrol pump and I say, okay, I'll pay you on the first of the month, but then I'll buy the petrol at any day which I want. Would he agree? Probably not. The price for today is the price for today's delivery. That is called as the spot price. But if you want to buy it after 15 days, there would be a separate price. If you want to buy it after 30 days, there would be a separate price. If you want to buy it after 1 month, after 2 months, there will be a separate price. So for different maturities or different settlement durations, the prices are different. And that is because there are multiple components that make up a forward price. And these components affect the calculation of the price. And that's why different prices for different maturities. Now, some terminologies which we'll understand. Long position. Long position is always a position of buy. When you buy some commodity or buy some contract, you are in a long position. And the other position is a short position. When you sell it, you are in a short position. So again, going back to our example of the jeweler, you go to the jeweler and you say, I'll buy the jewelry at an agreed price after 2 months or after 3 months. You are holding a long position in the jewelry. And the jeweler is holding a short position because he's agreeing to sell, you are agreeing to buy. So that is the long and the short position. These positions become very important in understanding the futures, the strategies and everything in future. So long position and short position are the terminologies for buy and sell. A future contract bought is long position, a future contract sold is short position. Now let's take example. On 20th of November 2020, the treasurer of the corporation enters into a long forward contract. Now, long forward contract means they are ready to buy 1 million pounds after 6 months at an exchange rate of 1.3284 per pound. So they're going to pay, they're going to buy, they have agreed with the bank that after 6 months will pay you 1.3284 pounds, $1.3284 per pound, and buy from you 1 million pound. Now this is the transaction. So when is the transaction agreed? Today. When it is executed? After 6 months. So after 6 months, what happens? They are obligated to pay, the corporation is actually obligated to pay US dollar 1,328,400 for 1 million pound. This is how this is calculated. This is calculated based on the exchange, the agreed exchange rate multiplied by the quantum of the product. That is the 1 million pounds. So this much they have to pay by May 2021. 20th May of 2021, the corporation will pay this much amount and receive the pounds. Now, what are the possible outcomes in this? The exchange rate on that day may actually be lesser than 1.3284 or maybe higher than 1.3284. It can be either way. If it is lesser than 1.3284, the corporation will make a loss. They will make a loss because they are paying more than what they should be paying based on the spot price. Suppose on that day, the exchange rate has fell to 1.20. So that means for an asset that is valued at 1.20, you are paying 1.3284. So you are paying more. But at the same time, if the prices go to 1.4, then for something that is valued at 1.4, you are paying 1.3284. So you're paying less. You're making a profit. So you make a profit or you make a loss does not, so it is not defined at the time of entering into the contract. It is defined based on from the time of entering into the contract, which is 20th of November, till the execution date of the contract, which is May 20th, 2021. In this 6 months, how do the exchange rates fare? If the exchange rates and the pound dollar rate goes up, you end up making a profit. If the pound dollar rate goes down, you end up making a loss. And that is where you have to be very, very careful in identifying the strategy. Suppose you are expecting the market to be bullish, the pound to further strengthen, and you are expecting the pounds to go up and up, then it is better to go into a future contract, because then the possibility of you ending up making a profit is high. If you are expecting the prices to decline, then don't go into a futures contract, because you are the chances of making a loss is high. Okay, so that is how the outcomes are say analyzed. That is how the price is defined. In a nutshell, a forward contract is different from a spot contract. Why? In a spot contract, the contract is executed immediately. In a forward contract, it is executed at a later date. It has a maturity date. That is the date on which the contract will be executed. The settlement will happen. That is called as the maturity date. And there is a delivery price. The price is agreed upon today. If you go to a jeweler and say, okay, I like this, but I'll buy it after 3 months and we'll decide upon the price after 3 months. That is not a forward contract, because you have not agreed upon the delivery price. So forward contract to be complete, the maturity date and the delivery price both have to be correctly and agreed between the parties and executed at a later date. So all the terms are agreed upon, but execution is delayed for a maturity date period. And that is what a forward contract is. The delivery price is paid on maturity. It doesn't mean that you pay it today. You pay it on maturity, not today. That is the important thing. Now coming back to the futures contract, it is an agreement to buy and sell an asset at a certain time in future. Now, how does it differ from a forward contract? This is the same definition we heard about the forward contract. It is an agreement to buy or sell an asset at a certain price at a certain time. How does it differ? It differs because they are standardized. The terms of the trade are predefined. Predefined in the sense, what would be the quality of the asset, what would be the delivery location, what would be the delivery period, how the delivery would happen, all the terms of the condition, all the terms of the trade are defined, and based on that the trade executes. Anybody who wants to trade has to follow the same standardized conditions. These standardized conditions are called as the contract specifications. So if you go to the website of MCX and go to the product details there, you will find a specific contract specification, and that contract specification are the standardized terms of the trade. If let me just show you, try to show you if I can. Yeah. So this is the MCX website, and if you go to the products, you can see various products: bullion, base metal, energy. So let's take say in case of, let's take gold. So these are the contract specification, and if you click on the contract specification, this window will open. This is basically the terms of the trade. So what are the description, what are the listings, when will the contract start, when will be the last trading day, what would be the trading period, what would be the trading session, what would be the trading unit. All the terms and conditions are defined here. If you look at this, this is actually the terms and condition. Now all these aspects we will discuss in detail, just to give you an understanding about what this standardization. So anybody who wants to trade has to agree to these terms and conditions. If you don't agree to these terms and conditions, you cannot trade on a commodity, on a futures exchange. So futures exchange, in case of a forward contract, all these terms can be defined by you and the counterparty. In the futures trade, it is defined by the exchange, and exchange pre-sets all the trade conditions, and that is what is called as a future. That is what differentiates a forward and a future contract. So where a forward contract is traded on OTC, a future contract is traded on an exchange. What is an exchange? Exchange is an intermediary that brings buyers and sellers to the same platform for trade to be executed and transacted. And that is what is a role of an exchange. So they do, first they provide a platform for trade, they define the terms and the conditions, and then they risk manage the whole contract. Now, if you actually look at the difference in nutshell, the forward contracts are private contracts between two parties, you and me agreeing upon something to buy or sell or something. That's a forward contract. But if I go to an exchange and buy, it is an exchange traded. Now, why would I go to an exchange rather than going to an individual? Suppose you don't know me, I don't know you, and we meet on the, say we are traveling together in a train and we meet with each other. Would you be comfortable dealing with me on a trade? Probably not, because you don't know what my credibility is. You don't know what my background is. You don't know, am I an honest person, or am I going to make some, say, is it going to make some losses? What is my credibility? Am I going to make a default? Am I going to cheat you? All these things come to your mind. How do you actually ascertain? So you do one thing, you take my number, then you go investigate about me, you find out about me, and you say, okay, this guy is reasonably credible, I can trade with him. Then you agree into a trade with me. So who does the due diligence on me? It is you. Who bears the cost? You. So what happens to the forward contract? Cost goes up because you have to do a due diligence. That cost adds up into the cost of product, into cost of the trade. But at the same time, I go to an exchange and I say, I want to trade. They say, okay, these are the credible people. These are the people who we guarantee to be honest people. And that is how a futures exchange came up. If you actually look into the history of the CBOT, which was the first futures exchange in the modern times, the CBOT, the Chicago Board of Trade, actually got established because of this specific risk. People were making a lot of defaults. People creditworthiness could not be ascertained. So they said, let's make a trade body, which they called as the Board of Trade. And anybody who is member of the Board of Trade would adhere to the rules. They call it, my word is my bond. So when I say something, I honor that thing. So that is something which came up as a ground rule for trading in futures. They said, okay, if you are a member of the Chicago Board of Trade, or if you're a member of the Board of Trade, it means that you are an honest person and I can trade with you. And that is how exchanges started to become popular. That is how exchanges started to become important, because they absorb the credibility risk. They absorb the risk of default. Now you don't have to worry if I prove to be incredible. If I had to make a default, you are compensated by the exchange. So your risk is, my risk is absorbed by the exchange. So you are not exposed to the credibility risk that I bring to the contract. And that is what is the difference between a forward and a future. They're not standardized. These are standardized, only one specific delivery dates. There are multiple delivery dates. So you have a June, April, or you have an April, May, June deliveries. You can select which. See, when I standardize it, I make it, I make you suit to my say terms. So you can say, okay, out of my requirement, which of the contract suits me the best. But when you go to a forward contract, you can say, I can design as per my requirement. It's just like a ready-made shirt being purchased and a tailor-made shirt being received. So you go to the tailor, you give me the exact specifications and he stitches according to you. That's a forward contract. You go to a ready-made shop and you buy a shirt and fit yourself into that shirt. That is a futures contract. Okay, so that's the basic difference. Now going forward, a futures exchange. Why do we need a futures exchange? They are the centralized, organized, neutral, transparent platforms for buying standardized futures contract. What they do, they ensure the guarantee of the performance of each and every contract. This is called as novation. Novation is nothing but a step in which the exchange is the counterparty to every trade. So if you are buying from an exchange or you're selling to an exchange, you don't need to be worried who is the third party or who is the counterparty. The counterparty risk is absorbed by the exchange. So I, as an exchange sitting in between, is your counterparty. So whoever makes a default, the default is not passed on to the other party, but it is absorbed by the exchange. And that is what is the guarantee mechanism of an exchange. Now that means that the exchanges have to define their policies and trade procedures in such a manner that people are not allowed to make a default. Otherwise, if exchange starts absorbing defaults of everyone, exchange would go bust. And that is why exchanges that have been very, very strong in their risk management are the exchanges that have sustained the test of the times. You talk about the Chicago Mercantile Exchange Group, the CMA Group, you talk about the ICE futures, you talk about the exchanges in India. They have sustained for more than, Chicago Mercantile Exchange has sustained for more than 100 years. Exchanges in India have gone successfully for more than 20 years. All these things have happened because they have made their policies very, very effective. Exchanges are regulated by their own rules, which is called as the business rules of the exchange. Then there are regulatory bodies in India. SEBI is the regulatory body. There used to be forward contract regulator, which was called as a FMC, Forward Market Commission, which in 2014 was merged. 2015 was merged with SEBI, and today all the forward contracts in commodities, equities, derivatives, in any kind of asset class is derivative contracts in any kind of asset class is regulated by SEBI. And then you have the Government of India, who provides the broad level guiding principles. So the Government of India, Ministry of Finance provides the policy framework. Within the policy frameworks, the regulators, which is the SEBI in India or CFTC in USA, define the rules and regulations of the trade. And between those rules and regulations, there are rules of the exchange that govern the day-to-day operations. So this is also called as the self-regulatory organization. Which are the traders exchanges? There is Chicago Mercantile Exchange, which is there was CME and there was CBOT. Now both of them have merged and formed the CME. NYMEX has also gone into that. The London Metal Exchange, which is part of the ICE now. Then you have the MCX in India. You have the NCDX. You have the TOCOM in Tokyo. All these are top-level commodity exchanges across the world, and there are multiple exchanges, but these are the major exchanges across the world which are trading in futures. Now, example of a future contract, it is an agreement to sell. Say, suppose I agree to sell 100 troy ounce of gold in at 1729 per troy ounce in March 2021. That is an agreement on a say CME Group exchange, which is a futures exchange. I agreed to sell 100 barrels of crude oil at 4847 per barrel in May, again on MCX. This is a futures trade. I agreed to buy refined soya oil at 1282 per 10 kgs on NCDX in April. That is a futures exchange. So these are different exchanges, different trades that actually happen on exchange platform. Now, how does a payoff in future happen? Now, what happens if, so there is a physical inventory and there is a future transaction. So let's understand what happens with the future the inventory and the future transaction. So if the price fall, what happens? The inventory that you hold becomes less expensive or becomes less valuable. So you make a loss on the inventory held. But if you have sold a future, you make profit on the future sold. Because suppose, again, I'll take an example. There's a jeweler who holds an inventory of say 1 kg of gold, and he's worried that the prices of gold may actually go down. Now, if he does nothing and sits on the gold and the prices go down, he makes a loss, because the gold that was valued at 51,000 today is actually 49,000 a month later. So he has lost 2,000 rupees on 1 kg of gold, or on 10 grams of gold. So on 1 kg, that's multiplied. So what he does, he goes to the futures market and sells the futures contract. So he still holds the inventory, but sells the future contract. So what happens if the prices go down? What will happen? His inventory will become cheaper, but his profit on the future will go up, because he has already sold something which is valued at 49 at 51. So that is the profit on the futures. But if the prices rise, then what happens? If the prices rise, the profit on the inventory will happen, because something which was valued 51,000 today becomes 53,000 tomorrow. So the prices go up, your inventory becomes more expensive. But what will be the loss? Because you have actually sold something at 51,000 and which is valued at 53,000 today, the futures would be making a loss. So net effect would be there is a zero sum game. So you make profit on spot, you make loss on future, or you make loss on spot and profit on future. So the futures actually compensate the loss or the profit, whatever you make on the spot, by an equivalent or a similar amount on the other side. So at the end of the day, you end up having a predefined profit or loss, and that is how a future is used. So let's understand this. So when this is how the long position payoff happens, as the prices go high, if you see the x-axis, the prices going towards the x-axis means prices going high and high, you actually make more and more profit. Okay, from 51 to 53, 53 to 56, 56 to 70, you make profit. But if the prices start to go down, what happens? You start to make a loss. Okay, so this is a simple payoff of any long position, any position that where you hold physical inventory. Again, taking the example of Madhura Sugars, if Madhura Sugars or Renuka Sugars for that matter holds the inventory stock and the prices of sugar go up, they make profit. If the prices of sugar go down, they make a loss. So that's how the profit and loss is. In short position, if they have already if they've already sold or they have to buy in a later date, increasing prices means buying at a higher price or selling at a lower price because you've already sold and you make a loss. So growing prices in a short position makes a loss. Falling prices in a short position makes a profit. So what happens when you combine the position of spot and combine this position of futures? Then you have a payoff that is counterbalancing. So you have the same long position in futures and the short position in futures, the same payoffs happen. But if you combine the two, what happens? On one hand, you make a loss, and on the other hand, you make an equivalent value of profit. And your profit and loss negate each other. You end up having an offsetting position. This is called as an offsetting position. Okay. So your profit from futures or the loss from your loss from spot is balanced by a profit from future and vice versa. Now coming to the participants in the market, who are the participants? There are hedgers, people who are consumers like refineries in the sense gold, for example, crude oil refinery. Now crude oil refinery, for example, BPCL actually buys the crude oil and then refines it. So a rising price of crude oil is the risk for BPCL because their profits may actually be skewed because of the rising price of crude oil. Or edible oil refinery, soybean oil refinery for that matter, or say the sunflower oil refinery. So what will happen if the prices of sunflower or soybean go up? The profit on the refineries go down. So they are food processing companies, for example, traders, producers, even farmers. They are the hedgers. Anybody whose profitability depends on the prices of the input which come from a commodity market are hedgers. They try to avoid the price risk. They try to reduce the price risk, impact of the price risk, and that is what they do to hedge the risk. Then there are investors or traders who try to, which are brokerage house, retail investors, spot traders, institutional property traders. These are people who take positions in anticipation of a profit being made. So I anticipate the future prices of gold to go up. I'll go buy gold. I'll buy the futures contract of gold. I anticipate the crude oil prices to go up. I hear about a disturbance happening in Middle East. I feel that the price of crude oil may go up. I buy a crude oil contract. That is a speculator, or that is an investor. And there are arbitrators who take advantage of two markets, physical and this futures market, and decide upon the transactions. So here there are broking houses and commodity spot traders. People, for example, if they feel that this futures price is much higher than the spot price, they'll buy the spot commodity, hold it, and deliver it at a future price and sell the futures price. So they make profit on the futures and make an investment in the spot today, hold it till the maturity, and make a say profit out of the arbitrage. So that is how the arbitrage is. Consumption and investment assets. There are investment assets are assets which are held with an objective of having or making an investment. So the objective is to make profit out of the income or the value appreciation of the asset. So gold, for example, is an investment asset. Platinum, for example, is an investment asset. Equity future is an investment asset. So these are investment assets which are held with an objective of making a profit out of the value appreciation. And there are consumption assets. So consumption assets are assets which are held with an objective of consuming. For example, ITC, the manufacturers of Ashirwad Atta, holding the stock of grain or wheat is actually a consumption asset. For them, wheat is a consumption asset because it is actually to be used for the processing of their manufacturing activity. So it's a consumption asset. So any asset, if the trade objective behind the asset is making an investment or making profit out of the value appreciation, that is an investment asset. Any asset which is purchased, traded, or procured for consumption purposes is a consumption asset. And why do these two things? Because the consumption asset and investment assets have different ways of pricing and behavior. Why we say that a lot of times there is, and this is at the global level, we have been discussing this thing, especially at the United Nations Conference for Trade and Development, where we say, the financialization of the commodity markets. Now, what is financialization of commodity market? Financialization of commodity market is when the consumption assets get treated and traded as investment assets. When a lot of money starts to chase the consumption assets with an investment objective, where people start buying with a value appreciation in mind, that is the time when the speculative profits build up. And that is the time when the real nature of the assets get lost. And that is where the exchanges and the regulators have to step in and say, consumption asset cannot be treated as an investment asset. So then regulators come in, they put in a lot of restrictions. For example, in India, they say the positions can be created beyond a certain position only by hedgers. So if you have physical market operations, you can trade in these commodities. You don't have physical market operations, you can't trade. That is because they want to preserve the nature of the consumption asset as a consumption asset, not let the consumption asset be transformed into an investment asset. And that is what is important. So interest rates, as you know, there is annual compounding. When interest rate is paid once and compound, and that is added back to the compound interest that we studied in class 10th and 11th. That's the annual compounding. Then there is quarterly, semi-annual compounding. This is based on how much durations the interest is paid. If you get the interest every month, then it is monthly compounding. If you just get the interest once in 6 months, it's a semi-annual compounding. Once in 3 months, it is the quarterly compounding, that way. And then there is continuous compounding. So continuous compounding is that every when the duration starts to reduce from annual to semi-annual, semi-annual to quarterly, when this duration becomes infinite, that is called as continuous compounding. This is a theoretical concept where the compounding actually starts to become continuous without time lag between the interest being accrued, paid, and reinvested. So in semi-annual, the interest is accrued for 6 months, paid, and then reinvested for next 6 months. In quarterly, it is paid for 3 months, reinvested for next 3 months. In continuous, it is continuous process. And there are various say interest rate formulas that we use for this. So how do we actually use the futures contract? There are two ways of pricing the futures contract. One is cost of carry model, where you increase the where you add the cost of carry. Cost of carry is nothing but holding the cost of actually holding the commodity from today till the maturity date. That is called as cost of carry. The cost involved in carrying the product in inventory from today till the maturity date. What are those costs? These costs include, this is basically the future prices, spot plus cost of carry. Just example, if I'm selling an say if I'm selling a gold, and you come to me and you say, I'll buy the gold, but I'll buy it after 3 months. Or let's take example of, say, timber, because it's more of a consumption asset. So I'm big logs of timber I'm selling, and I say, okay, I'll agree upon the price, but I'll take the delivery after 3 months. You'll say, oh my God, but for 3 months, the money I have invested into the asset and the working capital that I'm paying, interest on the working capital that I'm paying, I'll have to pay that interest for 3 months, because you'll pay me after 3 months. I'll have to put those assets into my warehouse. That means the rent of my warehouse is again included. I have to take insurance on my warehouse. So the cost of insurance is also there. So there is a cost to me. So I cannot give you at the same spot price. So what I'll do, I'll calculate all that cost and say, okay, for me to hold the assets for another 3 months, this is the cost added to the spot price. So after 3 months, I'll give you the commodity at this agreed price, which is spot price plus cost of carry. That is what is the cost of carry model. Now, what constitutes the cost of carry? It cost of financing, my working capital finance that is involved in the asset, which would otherwise be liquidated. So if I am, we say, I think you all know that that proverb, a bird in hand is worth two in bush. So if I have the money in my hand today, I can invest it. I can make interest. I can earn interest on it. So there is a cost of financing. If I keep that asset invested into, if it is a borrowed money, I'll have to actually keep the asset into the money invested into the asset for another 3 months, and the interest that I pay for 3 months is the cost of financing. So that I will charge to the future price, or that I will add back to the future price. Cost of storage, the warehouse charges, insurance, all these costs will be added back to the spot price, and then the cost of carry would be calculated. And idealistically, the futures price should be between spot plus cost of carry. If the future price is more than spot plus cost of carry, that means you have an opportunity of buying the spot price and carrying it till future and selling it at a future price, making a profit between the calculated spot plus cost of carry and the actual futures. And that is where the arbitrage opportunity comes up. Okay. So moving forward, let's understand how to value the futures contract. Spot price is S0 is dedicated as the spot price for today. So if I go to the market and buy whatever commodity at today for today's delivery, that is the price at which that can be delivered. That is spot price. F0 is the forward or the futures price for today. So from today, say 1 month future, 2 month future, 3 month future, that is the futures price. Time is the time until delivery, and the risk-free interest rate of for maturity. So these are the 4 components based on which the valuation happens. Now I'll take an example of gold futures price. Suppose that the spot of price of gold is 44,686. Now this is the price from the last month, that is the March 2021. Okay. The 1 month interest rate is 5.5% per annum. This is the risk-free rate of return in India right now. If you actually look at the risk-free rate of return, that is around 5.5% say per annum. So the interest rate, this is based on the monthly compounding. So because we are actually calculating for 1 month, so a 1 month compounding interest rate for the futures contract is 5.5%, or for any risk-free asset is 5.5%. There is no income. We are assuming, this is the assumption, that there is no income or storage on gold. Okay. And what should be the future price now? So you have the spot price, you have the future, you have the interest rates. What should be forward for the future price? Then the futures price is spot plus cost of carry, as I said. How do you calculate?
Pending.
Hello. Okay. So cost of carry will be spot price is 44,686. That is the spot price today. If you go back to the example again, the spot price is 44,686. So we take that as the spot price. And how is cost of carry? Cost of carry is nothing but the interest rate, because in our case, there is no storage cost, there is no insurance, no income or storage cost. That means the risk-free rate of return or the interest rate or the financing cost would be the only cost of component for cost of carry. So 5.5%, 1 month interest at 5.5% on 486 comes out to be 204.81. So this futures price would be 44,890. Now, if you look at the futures price and you find out that for a 1 month future delivery, the future price is say 45,000, for example. I'm just taking an example. What does that mean? The future price is higher than spot plus cost of carry. So what do? You buy the gold, invest money into gold, hold it for 1 month and sell a future simultaneously. That is how you decide. Okay. So this is how you calculate the futures price by using the cost of carry model. Now forward price of gold based on the compounding model. If the same S is the spot price and the F is the future price, T is the deliverable time, then the compounding model is F is the futures price is spot into 1 plus R to the power T. This is the same compounding. If you recall our old 10th class studies, this is how we calculated the compounded interest. 1 plus R to the power T, principal into 1 plus R to the power T, the same concept. Okay, so R is the risk-free domestic currency rate, risk-free rate of return. In our example, what is that? The spot price is 44,686. Time is 1 by 12 because that is 1 month. 1 month is 1 by 12 on a yearly basis, and the risk-free rate of return is 5.5%. That is 0.55. So that if we put it into the equation, we come out with a price of 44,885.82. So this should be the ideal future price at 5.5% of risk-free return for a delivery period of 1 month. Now, when you actually calculate these prices, you come to know that there are many times there is a difference between the speculated price or the calculated price and the actual price. Actual price is what? Prevailing on the market. You can go back and do this calculation. You can look at the spot price from the MCX website today. Take the time period, say 1 month, identify what is the risk-free rate of return, 5.5% is ideal, and then based on that, calculate this price and see what is the future price for today after 1 month delivery. So you'll find that this price and the future price, there is a difference. And why does that difference come? That difference comes because that is called as a convenience yield. Convenience yield is the yield that the product delivers by having the convenience of a spot or a future position. So if the futures price is higher, that means the convenience yield is lesser, and people are expecting the prices to go high. Convenience of certainty in future is higher, and that's why people are adding a premium to the futures price. Okay, so that's the convenience yield concept. Now interest rates are measured with continuous compounding. This is the formula. S0 e to the power RT. E is the constant. Assuming that there is no storage cost, F is the futures price, S is the spot price. We put it into the for consumption assets.
Excuse me, sir.
Yes, ma'am.
Sorry to intervene you. I just want to ask, it seems like out of two models, cost of carry model and the compounding model. So can we say because the compounding model is more apt as compared to cost of carry model, because it takes into account the present value factor or the time factor, we can say.
Yes, the cost of carry model is more used for the consumption assets. The compounding model is used for investment assets, and that's the logic based on which the price differentiation or the methodology to calculate is used. Various theorists have given these various models. I personally prefer using a cost of carry model, even if it is an investment asset, and I have more or less received better results using the cost of carry model. So this is again open for interpretation by the theorist or by the users. What type of model you want to use? You want to use the continuous compounding model, you want to use the annual compounding model, you want to use the cost of carry model. These are different models which can be used. As you rightly said, I would personally prefer using the cost of carry model because that is more realistic, specifically in commodity markets. If you're talking about an equity future, probably the continuous compounding, or if you're talking about the currency futures, probably the compounding model is more apt. But for commodities, definitely the cost of carry model is more preferred. Again, my personal opinion.
Okay, thank you.
Thank you. So if you actually look at the consumption assets, you also add an additional say value to it, which is the storage, because in consumption asset there is a storage cost. So not only the rate of return, the cost of carry becomes, or the cost of the compounding factor not only becomes the interest rate, but also the storage cost. So you add to it, and alternatively, if you add the storage cost to the spot price, S plus U e to the power RT, that is the way in which you calculate the consumption assets prices based on the continuous compounding model. Now let's take an example using chana prices. So chana prices in spot market are 4571 on 11th February. So these are again live market prices. On 11th of February 2021, the chana prices were 4571, and the risk-free rate of return again is 5%, as we are taking the 5% risk-free rate of return. The storage cost is 52 per metric ton per month. Now, where did the 52 come from? So if you actually look at the warehousing cost that the exchanges give of keeping the storage of chana, because chana cannot be kept in vault, chana cannot be kept in a shop, chana has to be kept in warehouse. So the warehouse charges are 52 rupees per metric ton per month. So that 52 rupees per metric ton is the cost. Now you have to remember that the prices of chana are quoted per quintal. The prices of storage is quoted per metric ton. So you will have to convert it into per quintal, and then you will have the prices. So now if you put in into the equation, that is 1 plus R to the power T plus C, which is the cost of carry, this will become 4571 into 0.05 to the power 1 by 12. That is 0.05 is the risk-free rate of return, 1 by 12 is the month or the T, and the cost of carry is 5.2. So that becomes 4594.82 per quintal. This is how you calculate the futures price based on the cost of carry model. Okay. So now what happens is, as the say prices, as you start moving towards the delivery date, or the expiry date, as we call it. The expiry date is the date on which the settlement of the contract happens. It is also called as the delivery date. It is also called as the end date of the futures contract. So as you start approaching, as the gap between the spot and the future period becomes lesser and lesser, what will happen to T? T will start to become lesser and lesser. And when T starts to become lesser, the difference between the spot and futures start to reduce. Okay. So what happens? The cost of carry goes down, because if it is 5.2 per month, definitely for say 15 days it would be lesser, for 10 days it would be further lesser, for 5 days it would be more less. So it starts to go down as we go from 2 months to 1 month, 1 month to 15 days, 15 days to say 5 days, and so on. So what will be the future price of delivery date, that is today, or today's future price would be the spot price? Are you getting this? Let me explain it in a more say in a different way. Now, what is a future price? It is a price for delivery on a specific date. Say a March futures which ends on 31st of March. The delivery date is 31st of March. So on 1st of February, you have 2 months for the delivery to happen. So the spot price will be the spot price of 1st of February. The futures price would be for the delivery on 31st of March. On 1st of March, the spot price would be price in the market for 1st of March, and the delivery and the future price would be for the delivery on 31st of March. On 28th of March, spot price would be for delivery on 28th, and the future price would be on delivery on 31st. On 31st, the spot price is also for delivery on 31st, and the future is also on 31st. So what happens? The spot and future becomes one. They should converge. And that is what is called as the convergence of spot and future price. As the spot and the future start to come closer to each other, the durations start to reduce, the prices start to come closer to each other, because the R and the R and the T, both factors start to become lesser and lesser. And because of that, the spot price for a future for a delivery today is, and a future price for a delivery today is same. And that is called as the convergence of spot and future. So ideally, again, I am using the word ideally. Why? Because in the next session, we'll understand why. Ideally, on the expiry date, the spot and the future should be same. They converge, they become one. And that actually starts to reduce as you start moving towards the expiry date. So for cost of carry goes on reducing, the interest rates go on reducing, all those components of cost of carry start reducing, because of which the spot and the future start to come closer to each other. That is what is the cost of, that is called as the convergence of spot and future. Okay, now we'll understand about margins. A margin is a margin basically. Now, why margin is required? As we looked into the forward contract, I agree with a jeweler or I agree with a person today to execute a trade after 1 month. So for 1 month, I am exposed for a period of 1 month. He is exposed for a period of 1 month. So the loss starts and the prices move on a daily basis. So the losses or the profits start to build up. Suppose the future price we agree upon for say gold is 53,000. The current price is 51,000. Tomorrow it becomes 51,500. How much is my loss? Because I am buying at 53,000. I make a profit. Say I make a profit of 500 because now say the gap is reduced. He's selling at 53,000, which is valued at 51,500. So now I am at loss of 500. Tomorrow the prices goes up. I am at a loss of 1,000. That keeps on building up. So on the execution date, the prices will actually encompass the loss accumulated over the period, and the chances of defaults will be higher, because higher the loss, higher the risk, higher the chances of default. To avoid that, what exchanges do? They benchmark it. They take and say there are two things that they do. One, they take a margin. A percentage of the trade is deposited so that at any point of time, your risk is actually balanced by the deposit. So if I make a default because of the risk, my balance would be sufficient to cover that risk, and that is called as the margin. So what happens? The marketable securities, cash, or whatever is to be deposited is deposited by the investor with his broker, and the broker deposits it with the clearinghouse. This is as a guarantee. Now, just take an example of a real estate trade. You go to buy a house, you like the house, you say, okay, I'll buy the house, but I'll have to process the home loan and all those things, and I'll pay you after 1 month. So what does the broker or the owner say? Okay, you give me a token amount. Now, what is that token amount? That token amount is kept as a guarantee and adjusted against your payment when you make the final payment. But if you don't make the final payment, what happens? That gets forfeited. Okay, same concept is applied in the futures contract. So you put in the margin, and that margin is kept as a guarantee value. If at any point of time you make a default, you don't honor your contract, that margin amount is forfeited and used to compensate the other party who has faced a loss because of the default. And that is done by the clearinghouse of the exchange. The financial settlements are handled by the clearinghouse. Now, balance of the margin is adjusted regularly or daily to reflect the daily settlement or the risk. And margins minimize the possibility of loss, as I said. So how does this margin fixation happen? In absolute terms and in percentage terms. So in absolute terms, you would say in international exchanges, it is in absolute terms. So they say, okay, $2,000 per contract, irrespective of the value of the contract. That is absolute margin. In India, we have a percentage-based margin. So we say, okay, the commodity futures would be having 8% margin. Now, 8% of the total trade value is the margin. Whatever is the trade value, whatever is the daily settlement value, based 8% of that is the margin. And every contract has its own margin definition. So it can be 8%, it can be 5%, it can be 11%, it can be 16%, it can even be 20%. Depending on how much is the risk of the commodity in terms of price movement, how much is the volatility in the commodity, and how much is the possibility of default, all these things put together calculate the margin terms. So let's take an example of futures trade. An investor takes a long position in a CPO. CPO is crude palm oil, a February CPO futures contract on 26th of November 2020. Now, contract size is 10 metric ton. future price on which the agreement or the trade has happened is 889.60 per 10 kg. Margin requirement is 8%. So how does this calculate 71168? How does this come? 889 per 10 kg for 10 metric ton. What will be the trade value multiplied by 1000? Okay, so 1000 kgs make up 1 metric ton, and 10 metric ton would be 10,000 kgs. So per 10 kgs is 889. Say 10,000 metric ton, what would be the trade value? 88.96 into 10,000. That will 8% of that is the margin. So this is the margin that the exchange will apply on the first day. Okay, how does this happen? So on the closing on 26th of November, when the daily closing price is the price at which you enter the trade is 889.6, the margin is 71,168. Now tomorrow the prices fall. The prices fall by to 875.90. So how much is the margin requirement? 70,072. 875 for 10 metric ton value multiplied by 8%. Now 70,072 is lesser than what you already have deposited. So there is no requirement to pay the margin. But the prices again go up at 870, then they move up to 876.2. The margin becomes higher. Now, if you have actually withdrawn the money from 71,168 to 70,072, then you will be asked to pay money. If not, then till 71,168, whatever is your margin balance at any point of time should not be less than the margin requirement. That's the underlying principle. So if you have withdrawn from the margin account, you have to pay. If you don't have withdrawn, if you are not withdrawn from the margin account, you can maintain. So this is how the margin calculation happens. Price quote is rupees per 10 kg, contract size is 10 metric ton, initial margin is 8%. So based on that, whatever is the daily closing price, the contract value of it, which is multiplied by 10,000 metric tons divided by 10, that would be the value multiplied by 8%. That is how you calculate it. So now working off mark to market losses. So when the prices move from a certain level from say 889 to 875, there is a profit or there is a loss. So if you have actually sold at 889 or you have actually bought at 889, what happens if the prices go down? You make a loss because you have bought something at a higher price than it is valued today. So what is that loss done? You have to pay that loss. And who is receiving that loss? The person who has made that profit. So if I have sold at 889 and the prices today became 875.9, that means I have sold something at 89 which is worth 875. So I have made a profit. If I have bought at 889 and tomorrow the prices go down to 875, I have made a loss because I have agreed to buy at 889 something is valued at 875. Okay, so this is how the M2M, we call it M2M. M2M is nothing but marked to market. Whatever is your loss or profit based on the closing price today is adjusted and paid and received today. So what happens? 889 closing price, tomorrow's closing price becomes 875. So the closing price is 875. Yesterday's closing price was 889.6. The difference is on one contract becomes 13,700 rupees is the loss that you make because you have agreed to buy something at 889, which is today which has been revalued at 875.9 today. What is 875.9 today? It is the futures expected futures price of the same delivery date as of today. So yesterday people were anticipating or undertaking a trade say for 31st of March on 889. Today they are for the same 31st of March for the same quantity, same contract, they are undertaking the trade at 875. So that means within one day, the people have readjusted their price expectations and brought it down to 875. But you have already agreed to buy at 889. So the loss between these two prices is your daily loss. Now tomorrow people realize, no, this is a wrong price and the market. Yes.
Excuse me, sir.
Yes. Please
there's a question, a query, sir.
Yes. Please go ahead.
If I'm not disturbing you.
No, please go ahead.
Sir, in this slide, as the price has moved down, it shows loss.
Yes.
So in the previous slide, why there wasn't a call for the loss? You said that margin call is 0 in the previous slide.
Yes. Yes. The reason is in this case, the margin, how much margin you have already deposited, how much is the balance with the exchange? 71,168.
Yeah.
Okay. What is the requirement now? 70,072. So the requirement is lesser than the margin that you have already deposited.
Okay.
So
So
that
it
is
will be
why, that is why,
8%. Yeah.
yes. Now, when it becomes 70,072, let's understand it from the minimum balance perspective of bank. So banks tells you your minimum balance requirement in the account is 5,000. Okay. You can keep money more than 5,000, no problem. But
Yeah.
if it goes below 5,000, the bank will tell you your minimum balance is below, now you pay or you deposit, right?
Yeah.
The same concept. Now, if you withdraw on the day when it is 70,070, you realize that you have put in about 1,000 rupees more. You withdraw that 1,000 rupees, and tomorrow the prices go up. Then the exchange will tell you your balance yesterday closing balance of the margin account was 70,072, provided you have withdrawn. Now requirement is 70,096, so 24 rupees you have to deposit.
True.
Okay.
So, sir, maintenance margin could be different than initial margin, or it will be same?
Yes, the maintenance margin concept was there in the earlier days in the Indian exchanges. In maintenance margin, what used to happen was the exchange would define a minimum margin requirement, and your loss, you would not be called in to put on the money unless and until your M2M loss adjusted against your margin account takes the balance below minimum maintenance margin.
True.
But now SEBI has discontinued that process. SEBI says keep the margin account separate and the M2M has to be settled separate. Earlier, what used to happen was the M2M was adjusted out of the margin account.
Okay, got the point. Thank you very much, sir.
Thank you. So this is how the M2M would be there. So whatever is the loss or the profit on the position today, benchmark to the expected future price of the delivery date, that will be paid or readjusted today. So tomorrow, if the prices go up at 876, so people have expected that no, this is too much below. This would be much better. The demand would be higher, so prices improve, go to 876.2. So you make a profit of because you were benchmarked at 875. Now the closing price become 876. So you are making a profit. So whenever there is a profit, you receive the payout from the exchange. Whenever there is a loss, you make a pay into the exchange. Okay. As I said earlier, the exchanges would adjust the M2M against the margin account. Now that doesn't happen. M2M is paid separately and margin account is balance is kept separate. Okay. So moving forward, some terminologies, last part of the presentation for this session, open interest. Now, what is open interest? That is the total number of contracts outstanding. It is equals to the number of long position or short position. For every long position, there is a short position. Okay. When there is a buyer, there is a seller. Unless there is a seller, there can't be a buyer. So one buyer and one seller make up one trade. So every position has a long position and a short position. Somebody holds a short position, somebody holds a long position. So total of the long positions or the total of the short positions put together will become the open interest. Settlement price is the price for daily settlements, which is basically benchmark, say how they are calculated. They are actually weighted average of the last 30 minutes. So 30-minute average price is taken and the settlement prices come. So the price in the margin calculation and in the M2M calculation, which we saw, is actually the weighted average of the last 30 minutes. There are elaborate rules of the exchange. If the last 30 minutes, there are less than 10 trades, then all the, all the trades are taken. Then it's elaborate rules, but the thumb rule is weighted average of last 30 minutes. Volume of the trade is the number of trades in a day. Okay. So it doesn't now there is a difference between open interest and volume of trade. So that is my question to you. When the new trade is completed, what is the impact on open interest? The open interest can actually go up, go down, or remain stagnant. We cannot confirm what will happen by a new trade to the open interest. Why? Because if there is a reverse trade, suppose you were buy and I was sell in a sell position. Okay. So you were long, I was short. And then we reverse our position. So I become long and you become short. So my net position becomes 0. Your net position becomes 0. What will happen to the open interest? 0. But what will happen to the volume? It will be 2, because one was long by me. One was long by you, short by me. The second one was long by me, short by you. So the two trades. Okay, so new trade can actually bring in open interest up, down, or it can remain stagnant. Anything can happen. Can a volume of the trading day be greater than the open interest? Surely yes. Why? Because volume is just every trade, irrespective of the direction of the open interest, is added. So any trade, buying one, selling one, net open interest 0, but volume 2. Okay, so that is how it works. I'll explain it again with an example. Now this is the graph that shows about the open interest of gold futures contract at MCX starting from 4th of June to 5th of February, 4th of January to 5th of February, a 1 month period. So you can see there are the blue line depicts the volume, the red or the orange line depicts the open interest. As the market tends towards maturity, or 5th February is the expiry date of this contract. Okay, sorry, for 5th February is as it is closer to the maturity date. So as it moves towards closer to the maturity date, this actually starts to become lesser and lesser, because people don't want to keep their positions open during the expiry period. So it goes down. But what happens to the open interest? The volume moves up and down. Let's again understand it with an example. Now there are 5 people: Arvind, Bharat, Chandan, Dinesh, Emmanuel. I have taken the example of 5 people. On day 1, Arvind buys and Bharat sells. So there is a 1 long position, 1 short position. Arvind is long, Bharat is short. Open interest is 1, volume is 1. Okay. Now on the next day, Chandan buys and Dinesh sells. So Dinesh is long. Chandan is long, Dinesh is short. So what happens to the open interest? Arvind and Chandan make up the buy side of the open interest, which are 2 trades. Bharat and Dinesh make up the sell side of the open interest, which is 2. So open interest is 2, volume is 2, because 2 trades have happened. Now on the 3rd day, Arvind sells and Emmanuel buys. So who is the new entrant? Emmanuel is the new entrant. But what has Arvind done? Arvind has moved out of the market. So what has happened? Arvind's buy position has shifted to Emmanuel. So is there a creation in open interest? No. Open interest by this trade would be 0. So the open interest will remain at 2, because there is an open position by Chandan and there is an open position by Emmanuel now. And there is a short position by Bharat, short position by Dinesh. So open interest remains at 2, but volume becomes 3, because there is 1 more transaction added. Then going to the next day, now Bharat sells 1 more contract. So he becomes 2 short, and Dinesh buys 1 more contract. That means Dinesh, who was earlier the seller, is replaced by Bharat. So Bharat holds 2 positions of sell, whereas Chandan and Emmanuel hold 1 position each of buy. So buy is 2, sell is 2, open interest is 2, but the volume becomes 4. Now this is why, because this is shifting of position. There are people who are shifting their position from one participant to another participant. Now on the 5th day, Bharat buys back, so reduces his exposure from 2 to 1. Chandan sells, he reduces his exposure again. So that means that the open interest is only 1, where 1 short from Bharat and 1 long from Emmanuel. And that means open interest is reduced. So there is a transaction, but the open interest is reduced. Transaction is 5, open interest becomes 1. And then finally on the 6th day, Bharat also exits the market, Emmanuel also exits the market, open interest becomes 0. The transaction becomes 6. So you can see there is a transaction that can add to the open interest, that can reduce the open interest, or remain it stagnant, but volume will always grow up. So this is how open interest and volume are understood. Now, how do you actually draw a conclusion from it? We call it PVOI analysis. PVOI is price, volume, open interest analysis. So if the price is rising, volume is rising, and open interest is rising, the market outlook is...
Excuse me, sir.
Yes, ma'am.
Excuse me, one doubt. Can you move back to the previous slide?
Yeah.
One small doubt I'm having. I just want to ask about the 6th day.
Yeah.
6th day, how open interest became 0? Because as far as I can see, Bharat has bought on 50th day also. Then
yes.
Now again on 6th day, he did not sold. He bought again.
Yes. Yes.
So
I'll explain
Emmanuel has cancelled his position, because on 3rd day he bought.
So if you look at the column of Bharat, there are 2 sells and 2 buys.
Okay. Yes, got it.
So 2 sell and 2 buy. So he actually, the sell that he was outstanding with, he cancels it. That's why it becomes 0.
Okay. Thank you.
Thank you. So if the market price is rising, that means at the rising prices, more and more people are creating positions. Because if open interest is going up, that means more and more people are creating positions. More people creating positions and volume going up in a rising market means the prices are bullish. If the prices are rising, but open interest is going down and volumes are also going down, that means the prices, more people are exiting the market than people joining. That means this is the sign of a trend reversal. The steam in the bullish prices is exhausted and now it is going to reverse. Falling prices with increasing open interest and increasing volume is a bearish trend. And falling prices with volume and open interest falling is a reversal trend. Now, if the open interest is going up in any direction, the increase in the open interest is actually an indication of stronger trends, because more and more people are going with that trend. So bullish trend being with an increasing open interest, or a bearish trend with an increasing open interest is a more stronger trend to continue with. Okay, so that's how, based on the price, volume, and open interest, you can understand the market outlook. So I think I'll stop here for this session. I think I have crossed the time a bit. I'll just stop here because it has been a lot of things. I think we all need a break. So we'll take a break and we'll come back with the more advanced concepts in the next session. So before we close, any questions if you have, we can either take it now, or if you want, we can take it in the beginning of the next session, whatever is, ma'am, whatever you suggest.
Sir, as you said, else we'll come back together at 12 and we can take the queries as per your discretion, sir.
I think then let's do that because then we can continue the discussion. Say once we have the query, people can actually think about the questions and come back after the break. That's all. That's fine.
So Rajat sir, I guess Rajat sir was
yes, ma'am. Hello sir, this is Rajat Kumar Soni. Sir, I have a query, not a question.
Yes.
Sir, basically there are some of our scholars who want to work in a field of commodity market, but the challenge we are facing that we don't have access of the database like Proves, commodity Proves or Bloomberg database. So do you have any information regarding how can we get the data from the registration via registration in a particular institution or by the way of any other source?
See, if you want
because sir, it is very costly to have a subscription of Bloomberg, or many of the institutions have a subscription of core Proves, that is the financial Proves, but my institution not have a subscription of the commodity Proves. Sir,
yes.
Just I want a suggestion from your side.
For example, if let me just show you, if I just go to the MCX website.
Yes, sir.
Yeah. So this is the MCX website. Let me just go back here. Market data. Okay. You click on market data and you see market watch, most historical data, contract wise, high, low, market heat map, a lot of information on the website. These are delayed information. These are historical information. But for a researcher, if you want to actually work on a historical information, if you actually want to build a model which can actually get feeds from the real market and then create trading in signals, then you have to go for a real-time data. But here, most of the data, like for example, if you click on the historical data, you have year-wise, month-wise, date-wise. Then you have the Bhav copy. Bhav copy is actually the copy of the prices. So if you say commodity-wise, so I say future commodity, I say aluminium, just in taking an example, expiry date. So 31st March contract, from which date to which date? You can just show it,
yes,
download this data.
Sir, I just want to make clear one more thing, that the data taken from the MCX is authentic for the writing a research paper or writing a thesis.
Yeah. These are by design and by law, the exchanges are required to keep these data on their websites. So if there is any data that is being put up by the exchange on the website, you can be assured that this is authentic data.
Okay, sir. Thank you. So, sir, I just want to ask you, please share your PPT slide with us.
Yes.
If it is possible.
Yes. What I'll do is I'll share the PPT because it's too text heavy. So I'll convert it into PDF and send it through email. and then it can be circulated. No problems with
Yes,
that.
sir. So it can be a good help. So okay.
No, definitely. No problems with that.
As soon as
Thank you,
sir
sir.
will share PPT with us, we'll share it with the participants. No issues.
Sir, I
So
have one question.
Yeah.
Sir, we all know that during COVID-19 times, the price of crude oil went negative.
Yes.
And that is because of the cost of storage became high because of huge supply and less demand. But
Yes.
according to the formula, if the cost of storage or cost of carry increases, the future price should also increase. It should not be negative. So how it went negative?
There is a
during that
concept of
time?
convenience yield. And convenience yield actually, and that's why if you see all the metals market today, they are all in backwardation. What is contango and what is backwardation, we'll discuss in next chapter. I was reserving the discussion for that period. But yes, what happens is there is a convenience yield concept. Convenience yield basically is the benefit by holding the stock. So if the benefit by holding of the stock is negative, then the negative prices actually push the spot price below the push the futures price below the spot price, and that is what was happening. So the demand had completely stopped. So the convenience yield was very low, and because of the negative convenience yield, the prices went into negative. That was the explanation for that.
Okay, sir. Okay, sir.
Yeah.
Thank you.
So it's
Okay,
just
so
not only this cost of carry. Cost of carry is a positive aspect, but it is also adjusted against the convenience yield.
Okay.
So that is important.
Okay. So sir and all dear participants, we are taking break for 10 minutes. So sir, what do you say? Shall we come back together at 12:05?
Yeah, that's fine.
Okay. So participants will get back together at 12:05. Thank you so much, sir. Thank you.
Thank you.
Welcome back, sir. I think we can resume our session.
Sure. So, yeah, so we can start with some questions that were there.
But
yeah, ma'am, please go ahead.
Yes. Participants, if you are having any queries related to the session 1, I think Rajat sir or Ismail sir, Prateek sir, or like any of the participants having query related with session 1, please you can ask from sir right now. I think participants are also away like for a bit, I guess.
Yeah.
Sir, but you're like personally speaking, because I teach CDPRM, commodity derivatives, as a subject too. So it was a like very how very in a simple way, by taking simple examples you have explained us. So this is what we teach to students in start, when we start the syllabus, forward, future, contract. So even I jotted down so many points, so that even I can include those points, and how use and explain such concepts in a very simplest way.
Thank you.
Right. So
No, I think if any value addition can be created, that's the objective, I think. Yeah. And
Yes,
it's
yes.
something, sometimes what happens is, in my personal opinion, that we have so many international authors writing the books on commodity derivatives, making it very complicated. Whereas it's not so complicated. It's actually much simpler than it actually is presented to be.
Yes. So presentation makes a greater difference. How
Yeah.
I think we can resume session, sir. We can
Okay.
take the queries in between.
Okay. So we can start with the where we left in the last session. I'll just start with the presentation for this session. Yeah. So we'll talk about the advanced concepts in this session. What are we going to cover in this session is hedging, which is short hedge, long hedge, and the hedge ratio. How does this whole thing work? How do you actually calculate how much of hedging happens, and related concepts to it? And then we'll talk about spreads, calendar spreads. We'll talk about the pair spreads and the intermarket spreads. Now, calendar spreads are spread between 2 calendar dates. Pair spreads are spreads between the same expiry but 2 different commodities. They're also called as intercommodity spreads. And then we'll talk about intermarket spreads, same commodity, same expiry date, but different markets. So spread is nothing but 2 transactions coordinated in 2 different markets. Now, these 2 different markets can be markets or contracts of different duration, contracts of different commodities, contracts of different markets. So that's what we're going to talk about. So coming to the concept of contango and backwardation, I think this is the basic concept which we need to understand before we actually get into hedging and all the advanced concepts. So contango is a market where the futures contract price is higher than the spot price. Now, as we closed last session with the discussion around the contract price and the reason why the crude oil prices went down and things like that, as rightly pointed out by the participants, that the commodity futures should always be higher than the spot, because there's a cost of carry. So if you have a cost of carry added to the current spot price, you end up having a higher price, which is the market price or the expected futures price. That is called as the contango market. That's the normal market. We also called as the normal market, because that's the normal situation to be in. This is how the normal market looks like. At T0, when you actually start the contract, the prices may be different. And as we move towards the expiry date, the prices start to converge. They start to come closer to each other. The future prices and the spot prices start to reduce. Either the futures would start to reduce, the spot would start to grow up. The cost of carry between the 2 time durations starts to reduce. And that is why you have the price of the spot and the future coming closer to each other. On the expiry date, the cost of carry is 0, because it is as good as delivering a future today. And that is why the cost of carry being 0, the spot and the futures become 1. And that is called as the convergence of the market. So that is how a normal market behaves. Future price higher than the spot price, they go closer to each other because of the reduction cost of carry. And then at the end of the day, on the end of the session or the period of the duration of the contract, the spot becomes the future. But that's not always the case. You have situations where the price of commodity futures contract is below the spot price. And if you actually look at the current market situation, any contract in base metals you pick up aluminium, you pick up copper, you pick up lead, zinc, any commodity, you will see that the current future prices are lower than the spot prices. And that is if I call it an abnormal market, or that is also called as a backward market or a backwardation situation. So contango is spot being lower than future, normal situation. Backwardation is a situation where the spot is higher than the future. And why would that happen? That happens because the convenience yield of the product or the convenience yield of the commodity is higher than the cost of carry. So if you actually see the cost of carry calculation, cost of carry, if in detail, would be cost of carry, which includes the cost of finance, cost of insurance, cost of storage, other costs associated, minus the convenience yield. So if the convenience yield is higher, then it will actually mean that the spot price minus X. And that would mean that the spot price, the futures price would be spot prices minus X, lesser than the spot price, and that is called as the backwardation. Now the abnormal situation got maxed when in the gold in the crude oil contract, when the prices started to fall, and people were under the situation, or people were under the impression that in coming days the convenience yield will be say the shortage would be so high that actually it will actually be say higher than the cost of carry and higher than the price itself, and that's why we saw the negative pricing. We saw a negative price. Now, if the market is in backwardation, the convenience yield is higher than the cost of carry. When the convenience yield becomes higher than the cost of carry, you have the say market situation. If the shortage of the future situation, if the shortage of the product in the future is expected to be higher, the convenience yield would be higher. See, let's assume this thing. What happened when the lockdown was announced last year? Everybody started to run to the grocery store. Everybody started to pile up groceries in their house. Why? Because the expectation of shortage of the commodity was there. We were not sure that the grocery stores would be open, the grocery stores would be supplied, the supply would be there, nothing. So what we were worried, oh, if the supply doesn't come and I don't get commodity in the market, what will happen? So buy it as much as possible. And I am better off holding the stock today than actually buying it at a future date, even if the price at which I buy and the storage cost is higher than the future price. Normally, what would happen? I would say, if I can stop incurring, or if I can avoid incurring the storage cost, and if the storage cost is higher than actually carrying the commodity till the maturity date, rather than I'll just go and buy in future. But that doesn't happen sometimes, because you prefer to keep the storage. You prefer to keep the stock with you because you are anticipating a shortage of the commodity. And when you anticipate a shortage of the commodity, your convenience yield is higher. Because the convenience yield is higher, the prices become say spot minus X, and that is why the spot price becomes higher than the futures price, and that is called as a backwardation market. So backwardation market is when the spot price is higher, and that is primarily because the convenience yield is higher than the cost of carry. So that is what the backwardation market is. Now let's talk about hedging. What is hedging? Hedging is taking a position in future market that is opposite to the physical market. Why opposite to the physical market? Because what you want to do by hedging is balance your payoffs in the physical market with a equal and opposite payoff in the futures market. So you take an opposite position. Suppose you want to buy, say, a product in future, and you are worried about the say prices going up. You take an opposite position, which is a buy position. You are actually short right now, and you want to buy. You're going to go long in the future. So you go long now on futures and go short on futures at the later date. So that's how you actually make a hedging strategy. Suppose you want to sell something in future, you go short in future. You go short in future today and balance it by a buy position in the future in the later date. So that's just hedging. It reduces or limits the risk associated with unpredictable price change. Why? Because now you are balancing the portfolio by an equal and opposite opportunity to earn either a profit or a loss. Now, when you pick up the one end of the stick, you pick up the other end as well. That's the ground rule. So when you say, I would reduce my risk, you also reduce your profit potential. So when I say I'm going to execute a strategy that if there is a loss in the physical market, that will be covered in this in the futures market, and I will not be making a loss. But at the same time, you also say that I am not going to keep myself exposed and take advantage of the increasing prices. So suppose an component manufacturer is there, somebody who makes auto components, and aluminium and copper are the key inputs. Now he's worried that the prices of these components may go up. So what he does, he goes and buys it out of a futures contract on that, so that whatever is the increase in the prices can be negated by the increase in the profit in the futures prices. But at the same time, if the prices fall, what happens? He saves on the spot price, but he has to pay out on the futures price. And that is why we say that it reduces or limits risk, but it also reduces and limits the profit potential. And that is an important thing. The hedger is not looking for profit. A lot of people ask, oh, then what is the use of hedging? If I can, if the profit is, I want to manage my loss, but I don't want to compromise on my profit. It doesn't happen that way. If you have to do that, then you have to look for another option, which is an option itself. You look for an option contract and pay a premium, and then take that position, and that's a different ball game. But if you want to go for hedging using futures, then you actually have to. Your focus should be keeping stable your profit and the losses. If you want to lock in a profit and not expose yourself to a higher profit or a higher loss, then hedging is for you. The objective behind the mechanism is offsetting loss in one market with the gain of another. And this is a very important statement. If you read this statement, I have not used the word offsetting the loss in spot by making the gain in future. No, because it can actually be other way around as well. You can make a loss in the future and gain in the spot, but that is balanced. And at the end, if whatever is your target price, whatever is your target potential, you receive that. And that is a good hedging strategy. So hedging is not to take advantage of the market positions. Hedging is more to take advantage of or reduce your exposure and say manage your profit potential to a certain level which you are comfortable with. Now there are long hedge. There are two types of hedge. There is a long hedge and there is a short hedge. A long hedge is basically a hedge where you buy a futures contract, and a short hedge is a hedge where you sell a futures contract. So let's take an example of a long hedge. In an October month of 2020, a component manufacturer enters into a contract to deliver a component in the month of March. Now he's an auto component manufacturer. Somebody, if I take the example of Indore, somebody in Pithampur or somebody in Pune, where there are auto manufacturing clusters which are manufacturing components of automobiles. Now you have to deliver the component in March. The selling price of component you have already agreed upon with the price with say you are supplying it to Tata or you're supplying it to Eicher, you have agreed upon the price. Now copper is the most important ingredient. The price of the component is fixed. So what you want to have certainty in your profit, fixing the price of the copper as well. Because if the price of copper is volatile, then your profit margins are skewed, because the price of copper can actually say affect your profitability, because selling price cannot be adjusted. So what you do? There is a risk of increasing copper prices in February. You would be actually buying the copper in February, processing it in component would be delivered in March. But for that, either you buy today the copper and hold it till maturity, or you do some other thing to ensure that the prices don't affect. So the other thing is hedging. And how do you do that? You do that in October. This is how the hedging would happen. In October, the price risk is there for the physical copper may increase in February. So what you do, you enter into a contract. You have already entered into selling a component for delivery in October at predetermined prices. You have already agreed to sell a component to Aisha at a certain price. So what you do, you buy physical say in February. What are you going to do? You're going to buy the physical copper from the market and make auto component. In March, you are going to deliver the components. So this is your position. Now, what is the price risk? Your price risk is prices of copper in February may go up. And how do you do the hedging? So what you do, you buy a copper future contract. That is, today you buy a copper future contract, and by buying a copper future contract, you safeguard yourself against the increasing prices of the copper. So what happens if the copper to be purchased in the for manufacture of component, if the prices of the copper decrease in spot price, will benefit the auto component manufacturer, because you will make profit. You will be buying profit. You will be buying copper at a cheaper price, but increase in copper prices will make you a loss. So if you actually see what how the long hedge would work, this is based on the actual closing prices. So on 5th of October, the spot price was 510.50. And on February future, which is expiring on 26th of future, the future prices was 499.8. And on the 26th of February, the spot prices have gone up to 716.85, and the futures has gone up to 716.50. So that means in an unhedged position, you would have made, you would have bought the copper at 716.85, but you hedge. And what happens? How do you actually hedge? You enter into a futures contract on 5th of October. You buy a futures contract at what price? 499.8, which is the copper futures price on 28th of February for February delivery expiry. So the futures contract prevailing prices on 5th of October, 499.8. You buy that, wait for the prices to wait for the October month, February month to come, and in the February month, then you execute two trades. One is in the spot market where you buy, and another in the futures market when you sell. So what happens? What is the selling price of the futures market? It is 716.50. That is that day's closing price. So how much profit you make on futures? You make a 216.7 rupee per kg price, per kg profit on futures. And you end up buying the spot in the spot market, you end up buying at 716.85. So what is your net purchase price? 716.85 minus the profit from the futures, that is 500.15, which is very close to 499.80, which was your target price when you entered into this strategy. Okay, so this is based on the actual market prices. We have actually taken the current market prices from MCX for copper and calculated this. So when you actually do these type of trades, you lock in your futures price. So what has happened? This has actually ensured that you lock in your futures price close to 499.8. Now I am saying close to 499.8 because it is very difficult to have a perfect hedge. You don't actually get a perfect hedge where it is exactly the same price. The reasons are the basis. There are multiple factors which we'll see in the coming discussion, but there are multiple reasons because of which your hedge may not be perfect, and the prices may be little bit here or there, but grossly towards that. And that is why 500.15 and 499.85, another 35 paisa difference per kg is the only exposure you have. Otherwise, you have locked into the prices. Now, this has again assuming that you don't get the delivery from the futures exchange. Because if you get the delivery from the futures exchange, matter is finished, because 499.8 is your price. But futures exchanges normally only 2% of the future exchange trades actually go into physical delivery. And that is why you have to separately trade in the spot market and in the futures market and make a strategy of operating in both the markets to ensure that the profit is not compromised. So your target price of 500.15, if you have agreed upon a certain price with the component buyer, say Eicher Motors, your component price is fixed. Now you have fixed up your copper price, and based on that, you know how much your operating cost would be. Your profit is certain. This is how a long hedge would work. A person who is actually anticipating a procurement of a commodity from the market at a later date can go and buy a futures contract today and lock in a futures price. And that is how the hedge works. Now, a loss in the spot market can be offset by the profit in the futures market. Now, what is the loss in the spot market? Had you actually purchased it from the market and you actually, now let's talk about this thing. So on 5th of October, I had two options. The first option was buying from the spot market and holding it till maturity. So how much would I have paid? I would have paid 510.5 to buy from the spot market because that was the spot market price that day. And then I would have incurred a cost of carry for 3 months or 4 months. And then I would have ended up say paying spot price plus cost of carry. But I realized that the futures price is less, and if I actually the convenience yield is high, so I actually play on that, buy it, and end up having a futures end up having a spot price of 500.15, which is lesser than the spot price on 5th of October plus cost of carry. That is my hedging strategy, and that is why this hedging strategy has given me a profit in the futures market, which is more than my loss in the spot market, and that has covered my cost. See, objective is not to earn higher profit on the futures market. The objective is to earn sufficient profit to cover your losses in the spot market. So if you are making extraordinary profit on the futures market, that can be a windfall gain, but that is not the objective. People don't try to make that profit. People try to lock in the spot price as close as possible. If the spot price on that day was 499, the future price on that day was 499.8. If I can lock in around that, that is my profit. That is my objective. Okay. So now the other side. Suppose on the other side, there is a buyer who is actually expecting to say here the person was expected to buy. Now we are talking about a person expecting to sell. Let's take the example of a jeweler. Okay, a bullion trader has bought 1 kg of gold to be kept in his inventory. He is going to sell the gold in February 2021. So what is his worry? His worry is falling prices. In the earlier case, his worry was rising prices. So go into a long hedge. My worry is falling prices. So I go into a short hedge. So how does this work? In September, he has bought the inventory of 1 kg gold. And in February, he will sell the physical gold from inventory. So holding period of this is September to February, and the gold prices may reduce. So what do? I go into a short hedge where I sell a futures contract and wait for the prices squaring off to happen at a later date. Squaring off, again, I'm using a technical word. Squaring off is basically getting into exiting the futures contract. So if you have a buy position, you get into a sell position to square off. If you have a sell position, you get into a buy position to square off and exit the market. Okay, so you square off in the futures and make the profit earned in the futures benefit your spot transaction. So how does this work? So in September, he has bought 1 say kg of gold in the spot market. He will sell 1 gold futures contract. The contract size is 1 kg. He will sell 1 gold futures contract, and then he'll wait. He'll wait for February to come. In February, he'll buy the gold futures contract to square off the futures transaction. At the same time, he'll sell the physical inventory into the market. Okay. So in September, there are 2 transactions. He's getting long position in the spot contract and a short position in the futures contract. In February, he's reversing his positions in both the markets, getting a long position in futures contract and a short position in the physical market or the spot market. Okay. So how does the payoff happens? So payoff happens is the prices may go up or down. If the prices go from 51,000, that is today's price, to 55,000, the price on the physical market, he makes a profit and he makes a loss in the futures market. But if prices go from 51 to 45, which was his worry, he will make profit in the futures market and loss in the spot market. And these two will keep negating each other. And at the end of the day, his price would remain very close to 51,000, which is his target price. Let's see from practical example, does it work? This is very good in theory, but if we actually apply it in the physical market, does it actually work? Let's do that. So in this, he on September 7th, which is his entry date, the spot price of gold is 51,008 and the futures is 51,022. Now on the 4th of February, the prices have declined. Prices have come. The spot price has become 47,263 and the futures is 46,965. Now what happens? So he has entered. What was our strategy? He sells the futures contract and buys the spot gold. So he has bought the spot gold at 51,008 and his worry is the prices may go down. So he sells the futures contract at 51,022. On 5th of February, he reverses his transactions at the futures and the spot prices, and he makes 4057 as his profit in the futures contract and 3745 as his loss in the futures contract and the spot contract. So he has lost in the spot contract, made profit on the futures contract. The net profit is 312. This 312 is the windfall gain. Had this profit in the futures contract anything above 3745, his hedge would have been perfect. Anything below 3745, he would have incurred losses. Okay, so this is his ultimate profit, and he has made more profit on the futures contract and less loss on the spot contract, and that is what his balancing. So what has he ended up doing? If you actually look at the prices, he has actually made a profit of 312 rupees. He has actually been able to say sell at a price of say 51,008 plus 4057. That is his ultimate selling price. Any questions on these two scenarios? Okay, can I move to the next concept?
Yes, sir, sure.
Okay. So now these things, sometimes what happens, as I said, the hedge may not be perfect. Why the hedge is not perfect? Because the hedge is using a futures contract. And using a futures contract has its own limitations. Limitations in terms of quality of the asset. Because the quality of the asset that is defined in the futures contract may not be exactly the same that you deal in. So the spot price is pertaining to a certain quality and the futures price is pertaining to some other quality. That is a probability because of which the price movements may not be so highly correlated. Second thing is the duration. Futures prices are, or futures contract are for specific durations. They have specific expiry dates. Like for gold, there is always an February expiry, there is a April expiry, there is a June expiry, that way. 5th of February, 5th of June, 5th of February, 5th of April, 5th of June, that way. Or copper 31st of March, 31st of April, 31st of May, that way. But your period of hedging may not exactly coincide with the period of futures contract. So in that case, what happens? You have to either roll your hedge forward. And what is rolling the hedge forward? It is actually moving your hedge position from one contract to another. For example, if you have a one year long hedging strategy and the future is available for 6 months, you take a 6-month futures contract and then you move to the next 6 months. So you move from the near month contract to the far month contract. Now, what is near month and far month contract? Near month contract is the contract that expires in the upcoming month, or the closest expiry date is called as the near month. The far month is the last expiry date or the expiry date of the futures contract, which is the furthest in the trade. For example, if today I look at the copper contract, I have 31st March, 31st April, and 30th April and 31st May, 3 contracts, for example. So 31st March will be the near month contract and 31st May would be the far month contract. That is how. So you move from the near month contract, your position to the far month contract, and that is the rolling the hedge forward. You close out the existing position on the futures contract and take a new position in the future, the contract close to expiry. Now I'll give you an example again. For example, my hedge's duration is say 6 months. And from today, that is say 18th of March, 6 months is April, May, June, July, August, September. 18th of September is my hedge duration. But the market is offering me contract only up till July, 31st of July. So what I will do, I will buy a 31st of July contract. On 31st of July, I will square off the July contract and enter into a September contract. And that is called as rolling the hedge forward. And when you do that, you experience a risk, a rollover risk, because you have to close out a position and then open a new position. The closing out and the opening prices may be different, and because it is different, the price, the payoffs would be different, and that is the risk in the rolling the hedge forward. Hedge period, this is done because hedge period is longer than the futures contract available. As I said, the future contract is available only up till say 31st of July. The last contract, the far month contract is only for 31st of July, but your period is still 18th of March, 18th of September. So for the next 3 months, you have to roll over to a new month contract, and that is where the risk comes. We can use a series of futures contract for a life of the hedge. And each time we switch from one futures contract to another, we incur a basis risk, which is actually the difference between the two future prices. Okay, so how does this happen? If you look at this chart, this is the gold futures contract. The first one is the fifth, the blue one is the fifth, the February gold contract, and then the orange one is the April gold contract. So if you actually see, the total open interest remains same around say 120,000. Sorry, 12,000. Okay, it goes up to 14,000, but again comes back to the 12,000 figures. So 12,000, 13,000 is 14,000 is the open interest levels. But if you actually see in the graph, on 23rd of November, the component of blue is higher and the component of orange is very small. That means the open interest in blue in the February contract is high, and the open interest in the say April contract is low. But look at 1st of February. The open interest in blue contract is very small, and all that open interest has shifted to the April contract. So this is how the rollover is happening. From say 23rd of May, when it was peaked, it starts to go down. And if you see the orange component starts to go up, that means the people are moving from February contract to April contract, and that is what is the rolling over happening. Okay, people don't want to be in the, and this rollover is completed before 5 days of the expiry. The reason is last 5 days in gold is called as the delivery period. So anybody who has an open position during the delivery period can be asked to deliver physically in the market. And in the gold market, nobody wants to take physical delivery or give physical delivery on a futures exchange, simply because that doesn't make, there is an inherent limitation in the gold market specifically. So what people do, people square off their position and take a new position. They move out of February contract and move into the April contract. And that is seen by the reducing level of open interest in the February contract and corresponding increase in the open interest of the March contract, April contract. So if you see on 14th of December and on 11th of January, the open interest more or less has remained same. The total open interest has remained same, but there has been a switch between the February and the April contracts, and that is called as the rolling the hedge forward. That is how do you roll over the to the next contract. Okay. Now, what is basis risk? This is another risk which can make your say futures hedging strategy imperfect. And basis risk is the difference between the spot and the future price of the same underlying asset. So a gold 999 purity gold on a commodity exchange price and in your physical jeweler's shop, the difference between the two is actually the basis risk. Okay. So basis risk arises due to uncertainty between the spot and the future price. Now, if we can go back to the pricing model, we would say that the cost of carry is the basis risk, because the difference between the future is nothing but spot plus cost of carry. So what is the difference between cost of carry and basis? If spot minus futures is the basis, then cost of carry is the basis. Not really. The basis is actually cost of carry plus the convenience yield, and the uncertain factor in which is on a daily basis redefined is the convenience yield, because convenience yield is basically the anticipation by the market, the discounting of information by the market, and based on that the real price of the futures is defined. So it may not always be the future is equal to spot plus cost of carry. It is futures is equal to spot plus cost of carry minus the convenience yield. And how much is the convenience yield is actually going to be defined by the prices. Second reason why the basis risk arises, or second reason why you see the difference between the spot prices and the future prices not exactly corresponding to the cost of carry model, is because the underlying quality parameters for the spot and the futures may not be exactly the same. So if you have different quality parameters, if you have a 995 purity gold for spot for futures and 999 purity gold for spot, then the prices would obviously be different. So the spot price may not correspond to the future price, or the future price may not correspond to the spot price plus cost of carry. Okay, so these are the three reasons because of which the basis risk arises. Now what happens, why basis risk comes is the contract specification is designed by the exchange on a largely accepted terms of trade. Your terms of trade may not be exactly matching the terms of trade that the exchange has specified. So you're dealing in the spot market on a different terms of trade, and you're dealing in the futures market on a different terms of trade. And because of that, because of these two differences in the quality and the trading patterns, the prices may not be highly correlated. And that is what is the basis risk. Okay. So basis is nothing but spot minus futures price. It is not the cost of carry. Conventionally, ideally, it should be the cost of carry, because if it is cost of carry plus spot, which makes up the futures price, then the basis would be 0. Okay, but that is not the case. Positive and negative basis, if the spot price is higher than the futures price in a backwardation market, the basis would be positive. If it is a futures price is higher than the spot price, the basis would be negative. Normally, in a normal market, you have a negative basis. In a backwardation market, you have a positive basis. Now let's see the basis risk in aluminium, March 2021 contract. Now, if you see, this graph actually depicts the March future price of aluminium, which is going to expire on 31st of March, and you see the spot price of aluminium. So if you see on 4th of March, this futures price had a sudden dip. So the spot price suddenly went up. Now, this is an example of a day when the convenience yield suddenly got spiked up because of some market information, some price related indication, something happening in the market, which meant that the people had a worry about the physical market possession. So what happened? The basis suddenly became very wide. This market is in backwardation. Okay, the spot price is higher than the future price. So the convenience yield obviously is playing a major role. So this basis became much bigger, much positive, because the convenience yield started, the assumption about the convenience yield was very high. So suddenly people started going short on futures because people did not want to put a futures position, and they went long on spot. So people wanted to control. This is what would typically happen when say an external factor creates a threat of supply disruption. Now, for example, there's I hope that doesn't happen, but there's a war that is announced in the South China Sea between the Quad and the China. The Quad announces a war, or Quad announces an aggressive strategy against China. What will happen? A South China Sea disturbance would mean that 50% of the world global trade, which passes through the Strait of Malacca, is blocked. And blocking of that supply chain would mean that the physical asset that I have becomes more costlier, and suddenly you would see the spike in the spot prices and the fall in the future prices. The basis would react to it. Okay, and that is how you actually look at the basis, and then you say, okay, the basis is higher, basis is lower, and where the market is going. And the closer, this basis should be 0 on the expiry date, because spot and future are same. If the spot and future are not same, then the basis risk arises on the expiry. And why does that basis risk arise? The quality parameter may not be same, the terms of trade may not be same, the duration may not be same, multiple factors, and because of which the basis risk arises. Okay, so let's say how to minimize your basis risk. To minimize the basis risk, the price correlation between the spot and the futures should be high. So when you are looking at a spot as a futures contract to be selected for your hedging strategy, you have to first look at the price correlation. Any price correlation above 95% is minimum for a good hedge strategy to work, and the basis risk to be minimal. Okay, if the price correlation is 100, your basis risk would be 0. But price correlation is very rarely 100 in the real market. And that is why whenever you are getting into a hedging strategy, just calculate the historical bases and identify what is the basis risk. And that is how you define to define this basis risk, you actually look at the correlation. The convergence of the spot and the futures upon expiry has to be seen how the basis risk has played out in the expiry historically. Does the spot price and the futures contract actually say converge, or does that the spot price and the future price remains open? Now here it is important to note what spot price are we talking about. The spot prices defined by the exchange are different than the spot price at which you trade. Now suppose you are sitting in Indore. I'm just giving an example. You're sitting in Indore and you're buying the copper in Indore. Now the prices of copper in Indore may be different from the, maybe slightly, but different from the copper prices in Bhiwandi or Mumbai, which is the benchmark market. So the prices which the exchange would give as a spot market price with the spot price for Bhiwandi market. Whereas the price that you are actually dealing with is the price for Indore market. So that difference in the two price will inherently bring in a basis risk. So you may see, oh wow, this is very well converging. But the convergence is not actually real for you. The convergence, you have to actually plot it based on your own spot price. So you take the spot prices from your own sources, the spot price at which you are expected to deal with. And then mark it against the futures price which is available on the exchange platforms, and then see what is the basis. That is very important. Okay, so it's not just convergence of the spot with future, but also the spot has to be carefully looked in. What spot are we talking about? Are we talking about the correct spot price or not? That is important to see. You have to do a lot of research and analysis before hedging. You have to look into technical analysis, moving averages, relative strength index, Fibonacci. All these things are tools to define the future prices, tools to see how normally the future prices are prevailing, spot price correlations. All these things you have to work upon and look at the demand supply things, because there are commodities which have seasonal impacts. So you would see a period of time when the seasonality is impacted. For example, edible oils. Edible oils after the month of October start to become in backwardation, and after say April they come back to normal, and that is a trend that always you follow. The reason is that is the time when the demand peaks, because after October the Diwali comes, the vacation comes, the wedding season comes, celebrations come, so the demand for edible oil is higher, market go into backwardation, spot market are higher than the future prices. So you have to understand all these things and then see how do you actually work on the future and the spot basis. Any question on this basis risk before we move to the hedge ratio? Okay, so let's move to the hedge ratio. What is hedge ratio? So hedge ratio is basically how much we have now. What we have seen that the future and spot may not be exactly 100% correlated. So what do? You actually define how much future contract you need to cover your spot position, so that you achieve the same level. What is your ultimate objective? Your objective is to balance your cash flows from spot and futures. So your profit from spot, losses from spot should be covered by the profit from futures, ideally. And to do that, it may not be necessary to enter into an equal and opposite position. Equal position is one contract of spot may not be resulting in the loss that one contract of future may be resulting in profit. That is because of the correlation. Sometimes the future can give you more profit or more loss than a profit or a loss in spot. Sometimes it can be other way around. So that how much is that relationship? What is that relationship? How much loss of spot would be covered by how much quantity of future is the hedge ratio. Okay, so it is the ratio of the number of futures contract that you want that should be purchased or sold to ensure that the quantity of cash asset is properly hedged. So your portfolio inflows and outflows should be managed. it may come from two different values of trade. Okay, the spot you may deal in say 10 contracts, in future you may deal in 5 contracts, or for spot you may deal in 10 contracts, in future you may deal in 12 contracts. So the positions in the spot and futures may be different to ensure that the similar cash flow happens. That is important. The cash flow is to be has to be similar. Now, how does this happen? The formula to calculate the hedge ratio is change in the standard deviation of change in spot divided by the standard deviation of change in futures multiplied by the coefficient of correlation between the change in spot and the change in future. Okay, that is the hedge ratio. This is nothing but a simple regression equation that all the statisticians normally use. Okay, this is also called as the variance ratio. So if you actually look, I have taken an example, copper futures and copper spot. So correlation is if you actually take the last 6 months of copper future prices and spot prices from the MCX contract, you will find that the correlation is 0.97868253, which is basically 97.8683%. Highly correlated. Then I calculated the standard deviation of change in spot, which comes to 7.0256. Standard deviation of change in future, which is 9.0342. That means that the changes, the future are more volatile than the spot. Okay. So what will be the hedge ratio? Coefficient of correlation, that is 0.97868253 multiplied by the change in the standard deviation of change in spot versus standard deviation of change in future, which comes to 0.76. And to ensure that the hedge is there, 7.6% is the 7.6 contracts or 8 futures in the contract. Now let's see if actually it works. Now, spot market expectation to buy 10 metric ton in future. On 5th February, what is my strategy? My hedge ratio is 0.76. Contract size is 2.5 metric ton. How did I find the contract size? You go to the MCX website, look at the contract specifications. You find that 2,500 kilograms or 2.5 metric tons is the contract size. Position will be now 10.76. 0.76 is the hedge ratio. So for 10 metric tons, how many metric tons I need? 7.6. But that means that it is the available is 2.5, which means that I will get into 3 contracts. It will not be a perfect hedge. Why? Because for perfect hedge, I require 7.6 metric tons. And in the futures, I can deal in 2.5, 5, 7.5 or 10. Because the contract size is 2.5. So I'm actually using 7.5 metric ton in futures. So I'm using lesser than the hedge ratio because I cannot have the exact hedge ratio equivalent amount in futures trading. Okay. So this is what prices is 499.8. We have again taken it from the historical prices that we used. On 26th of February 2021, I sell the futures, buy the spot. My spot price on that day is 712, futures price is 716. What happens on the how much profit I make on the futures contract? The difference between this the entry price and the exit price multiplied by 2,500. 2,500. Why? Because this is price per kg. Our contract size is 2,500 kilograms, which is 2.5 metric tons, and 3 is the number of contracts. So I made 16,22,625 rupees profit on the futures contract. Net purchase price of my spot becomes 712 multiplied by 10,000 metric ton, 10,000 kgs, which is 10 metric ton, which is 71,28,500. Out of that, 16,22,625 is adjusted by the profit from futures. So my net purchase price becomes 55,05,875, or the price becomes 550.5875 as against 510 on 5th of October. So my hedge has actually helped me to bring down my purchase price from 712. If I had kept the position open, I would have landed up buying at 712.85. Because I have hedged, my position has been 550.5875. But was my hedge perfect? No, my hedge was not perfect because my target price was 510, whereas I have ended up purchasing at 550. So around 40 rupees per kg, I have paid more. And that is why, because I have under hedged by 0.1 metric ton. And the correlation is not 100. And because of these factors, I have been able to reduce my profit, my loss. I have able to reduce my loss, but not to the same and equivalent amount. And that is why my purchase price is slightly higher than my target price, because my hedge is not perfect. That is how a hedge ratio works, but it is as close as possible to perfect. You cannot get a perfect hedge in a futures contract because of multiple reasons, like the contract size, like the duration, and all those things. Okay. Any question on this? Okay. So strengthening and weakening of basis, let's understand what is that. When you say the basis is strengthening, the basis is strengthening when the cash price of the commodity increases more than the futures price. Okay. When the increase in the cash price is higher than the increase in the futures price, you say basis is strengthening, because the ultimate reduction in the basis happens. Basis is spot minus futures. If the spot price increases much faster than the futures price, then the real gap between the two starts to reduce, and that is called as strengthening of the basis. What is called as basis weakening? Basis weakening is actually when the commodity prices with future price increases more than the spot price. The spot minus futures means the price at which the futures price is increasing is higher, so the gap starts to reduce much faster, and that is what is weakening of the basis. Okay, so weakening of the basis happens when the futures price of the commodity increases much faster than the spot price. Strengthening of the basis happens when the commodity prices become more and more stronger in spot, comparatively lesser stronger in future. So if the cash price increases more, you say strengthening. Future prices increases more, you say weakening of the basis. Then there is concept of narrowing and widening of the basis. Now, what is narrowing of the basis? Narrowing of the basis is the absolute difference between the spot and the future reduces. Okay. Now, this can happen because of multiple reasons. The absolute gap can reduce because spot is remaining constant and future is the future is falling. Spot is increasing faster than the future. Any of the reason. So we don't know exactly what is the reason behind narrowing, but narrowing is in absolute terms, strengthening or weakening is in relative terms. So a lot of times narrowing and widening is used interchangeably with strengthening or weakening. That is not the case. Narrowing or widening is to be used when the absolute difference is looked at. Weakening or strengthening is looked at when the relative strength of the futures and the spot is looked at. Okay, so narrowing of the basis is when the absolute difference between the spot and the future reduces. For example, the spot, if the basis was minus 10, it was because 500 was the spot price and 510 was the future price. So basis would be minus 10. Now spot price remain at 500, but the future price reduced to 505. So what happens? The basis has actually narrowed. Now the basis is minus 5. From minus 10, it has come to minus 5. That is the narrowing of the basis. Why that has happened? Because the future has fallen much faster. Spot has remained stagnant. Future has fallen. Spot fall by 10. Future fall by 20. Basis remains. Basis is further reduced. So that is how the widening and the narrowing of the basis happens. Basis is widening when the basis when the absolute difference between spot and future increases. If from minus 10 it goes to say minus 20 or minus 30, that is actually widening of the basis. Okay, so if the futures say fall much faster, then the widening will happen. Now basis in contango market, who benefits when the basis in the contango market narrows? What is narrowing of the basis? Narrowing of the basis is when the absolute difference reduces. In a contango market, the spot is say lower than the future. So who benefits in a contango market where the future price is higher than the spot price? narrowing of the basis will benefit the short hedger. Why? Because this will happen because of the future prices say falling much faster. So one who sells the futures and buys the underlying commodity benefits. Okay, so this will happen when the futures price, so the narrowing of the basis will happen when the futures prices start to say fall, and when the future prices start to fall, the person who is a short hedger will actually benefit because he's making profit on the say future price, or maybe the spot price start to rise. And if his spot price start to rise, he makes profit on the underlying commodity. So either of the two reasons can actually narrow the basis: the falling of this futures price or the increase in the spot price. In either of the case, the short hedger benefits. In a contango market, when the basis widens, then in that case, the long hedger benefits. So a contango market, long hedger benefits in widening of the market, the long hedger loses in narrowing of the market. In a contango market, short hedger benefits in the narrowing of the basis and loses on the widening of the basis. Okay, so is this clear? It's a bit complicated concept, but anything you would like to ask on this?
Just one thing to check.
Yes,
sir.
Yeah.
So is it possible to manage the hedge ratio?
Yes, see, what happens is when you actually look at the hedge ratio, manage the hedge ratio in the sense you have to actually keep moving from the futures price or the futures contract from one contract to another, which is highly correlated. Normally what you see is a lower a far month contract is less correlated with the spot. A near month contract is more correlated. So you keep moving from one contract to another, but then you increase your risk of rollover. So all those components, all these parameters have to be looked in, and based on that, you have to actually manage the hedge ratio.
Okay, sir. Thank you.
Yeah. So hedge ratio basically will define how much, say you actually how much futures, how much close you bring the future and the loss and the profit from the futures. Okay. The contango market and the in the contango market where the future price is higher than the spot price, narrowing benefits short hedger, losses to long hedger. Widening, benefit to long hedger, losses to short hedger. This is how the concept is. In the backwardation market, it would be exactly opposite. When the backwardation market, when the spot prices are higher than the futures price, the narrowing of the basis benefits the long hedger, and widening of the basis benefits the short hedger. Okay. So these are the concepts which you need to remember, and based on that, you need to see what would be the outcome of the narrowing or the widening of the basis on the hedge strategy. Okay, now we'll talk about strategies. The simple strategy is actually long futures and short futures, where there's nothing to explain. You buy a short. If you anticipate the prices to go up, you go long. If you anticipate the prices to go short or fall, you go short. But the important concept comes in spreads. So spreads is basically a trade in which you buy two separate contracts. Now these two separate contracts can be two different time expiry periods, a January and a February contract, or a February and a March contract. That is a spread based on time, which is called as the calendar spread. Then you have say two different say commodities. You buy lead, you buy zinc. You buy natural gas, you sell crude oil. Two different transactions, two different commodity based contracts. That is a commodity inter-commodity spread. Same commodity, two different markets, same expiry, two different markets. That is the intermarket spread. So spread is basically buying one long and one short future contract, or getting into one long and one short future contract of different parameters. These parameters can be based on time, commodity, or expiry date, or markets even. Okay. Now, what is a fair spread? Fair spread is the ideal difference between the two contracts that you are dealing. So if you're talking about two contracts spread across two time periods, then there is always a relationship between the two. That the future and the near and the far month contract would approximately this much be apart. If you're talking about two commodity say spreads, which is lead and zinc, you know that this is the ratio. That is a fair spread. Fair spread is an ideal difference or a standard difference between two contracts that you are dealing in. Okay, and if there is an increase or reduction in the fair spread, if the spread is actually higher or lower than this ideal spread, then you go for a spread strategy. The types of spread, as I said, intra-commodity, same commodity, different time durations. Inter-commodity, two different commodities, same time duration. Inter-market, same commodity, same time duration, two different markets. We'll take example of each of these. Now, what happens? How does this spread actually benefit? So, if you actually look at the spread strategy, a long leg of the spread goes up and the short leg goes down. So you, as I said, spread is basically going into long in one contract and short in another contract. So if the spread long leg goes up, that means the contract that you are long, the prices go up, you make a profit on the long future. At the same time, the short goes down, you make profit on the short future as well. And the net impact is profit on both the sides. It can happen that the long leg goes up, but the short leg remains unchanged. So in that case, you make a profit on the long say contract, but you don't have any change in the spot on the short contract. Still you make profit, which is the profit on the long future. Long futures remains unchanged, short drops, reverse happens, you make profit on the short future, no change in the long, still make profit. Both lengths go up. Now it can happen that both go up together. So in that, the long leg will give you profit, the short leg would go will give you loss. And then in that case, you make a profit because the short is going higher, fast. Short is going up more than the long is going up more than the short. Reverse can happen. Both drops, long drops less, then you get say loss in the long, profit in the short. So ultimately, it might look quite complicated. Ultimately, the objective is making profit on one contract, accommodating the loss on the other contract, but ensuring that the direction of the profit is higher than the direction of the loss. The quantum of the profit is higher than the quantum of the loss. And that is what you make, say, that is what makes the spread contracts. Why does this thing happen? Because the gap can actually increase because of multiple factors. You don't know why this is there. It can happen because the long future, the one contract is underpriced or the other contract is overpriced. These are the two reasons. Okay, so the gap has reduced, the spread has reduced because one contract is underpriced, the other contract is overpriced. Or gap has increased because the one contract is overpriced, the other contract is underpriced. Either of the two. So when you see this, the gap getting higher or lower than the normal, that is because of mispricing in one of the contract. And you don't know which contract. So what is going to happen? The mispricing is going to correct. So if it is underpriced and the gap is reduced, say because of the underpricing, you go long on the underpriced and you go short on the overpriced. And then either of them will correct and you'll get profit. I'll explain it with an example. Let's take an example. So let's start with the intra-commodity spread. So intra-commodity spread, the strategy is there is a bull spread and there is a bear spread. Now, what is a bull spread? Bull spread is you buy the near month contract and sell the far month contract. So you believe that either the near month is underpriced or the far month is overpriced. When the gap has actually widened, you say the near month, either the near month has underpriced or the far month has overpriced, and because of which the gap is wide. And to make benefit out of it, you actually buy the near month and sell the far month. Bear spread is actually buying the far month buying the far month contract and selling the near month contract. It's the reverse. So these are the two spreads that you do. Reason: the bull spread is widening of the spread. There is a widening of the spread. The spread has gone wide, and that can either be because the near month contract is underpriced and far month is or the far month is overpriced, and because of which the two have actually separated more. So what is going to happen? If the far month is overpriced, it is going to come down. If the near month is underpriced, it is going to go up. And the direction of the correction will be higher than the direction of the correctly priced contract. That is the theory. So what will happen when you buy the near month contract and sell the far month contract? If far month is overpriced, it will fall. You'll make profit. If the near month is underpriced, it will go up. You will make profit. So either direction the price moves, either direction the correction happens, you make a profit. Bear spread is when the narrowing of the spread happens. Narrowing happens because either the near month is overpriced or the far month is underpriced. I am again saying these are or. You don't know what is actually the situation. So you enter into the two market, you buy the far month contract, anticipating it is underpriced. If it is correctly priced, it will not correct. The other one will correct, and you go sell or you go short on the near month contract. So near month will fall, or the far month will go up. Either of the two things will happen, and that is when the price would again come back to normal. How does this work in real market? So on 22nd of October, you see the prices of crude oil futures, and you find that the spread is actually 58, positive 58. That means the gap is 50. This is you know that this is wider than the normal gap. This gap is normal. Now this widening has happened because either the near month, which is the January future, is underpriced, or the February future is overpriced. You don't know. So what you do, you enter into a strategy, which is basically you buy the near month contract, which is the underpriced contract, and you sell the far month contract, which is the overpriced contract. So you buy the near month contract at 311, and you sell the far month contract at 3169. Okay, and then you wait for the prices to correct. When the prices correct on 24th, this price becomes reverse. You get into minus 30. So this is the time to exit the spread. So this is the time when you actually square off the transaction. So you square off the transaction by selling off the near month contract at 3303 and buying back the far month contract at 3273. Okay, so ultimately what you make a profit of 192 on the near month contract and a loss of 104 on the far month contract. Now that means that the price movement upwards in the near month contract was higher. And what was your anticipation? Your anticipation was this gap has widened because either the near month contract is underpriced or the far month contract is overpriced. So near month contract actually proved to be underpriced, and that is why it corrected more. The price directional movement on the upward side was higher. Both of them have gone up, but the near month contract has gone up much faster, much higher than the far month contract because it was more or less rationally priced. So at this point, had this been opposite, had the far month been underpriced, then the price overpriced, then the price would have fallen, and price would have fallen more on the far month contract than on the near month contract. That did not happen, but the correction in the price happened in the January price or the January futures price, and you made a profit of 88. Okay. So any doubt on this illustration?
Sir, I want to ask one question.
Yes.
In the above, when we are talking about October prices 3111 and 3169, and the spread is 58. So how we are able to say that this spread is like of greater value? Yeah, this spread is greater.
Yes.
Like
so
how
what you do is you analyze the historical prices between the between the two futures contract, and you come out when you actually put it on the graph, you actually find. Let me see if I have put it on the graph. Yeah. So what this is the answer to the question. So how do you actually know if the spread is correct, if the spread is widened, narrowed, what has happened? In hindsight, it's always good to know, but you actually look at the historical prices, seasonally adjusted now. Sometimes because of the seasonality, the spreads get wider, but that's not, that has to be discounted. And then you look at the recent market levels. All these things you look at, and then you identify. Let's see if I have put it on a graph. Okay. So this is the graph. So when you look at the November months, you realize that the gaps are much higher. Then they actually overlap. That means the spread has become so this is the narrowing of the spread. In case of say the date we had, let me just go back to the earlier example. So we actually on 22nd of October, on 22nd, let's see what was the spread on 22nd of October. So on 20, okay, so this is a different, I've used the natural gas price. I'm sorry, it's not crude, but the natural gas. So natural gas prices, if you actually look at the prices, you would see the gaps actually narrowing in case of first week of December. Now, this continues till 4th of January. So the whole of December, it is more or less overlapped. The January and the February prices are overlapped. So these are the periods when you know that the gaps have, the spreads have actually reduced than normal. And then you again look at the, say, post, say, 4th January, you find that the it has again started to emerge. Then again, it gets closed down in 18th of January. So these are durations when you find out that the spread is not normal and the spread has actually widened or say contracted or narrowed. And these are the times when you actually get into these trades. At this point of time, you don't know what is the reason, what would correct. If you actually look at the natural gas prices in say on 6th of January. So 6th of January, the January prices have gone much higher than the February prices. That is because the January prices were underpriced and the directional movement they took was much faster, much higher on the say as compared to the February price. So what you do, you go short. This gap has narrowed. You go short on January future. You go long on February future. The February future goes up, doesn't give you that much of loss, but the January future which you have gone short on actually gives you more profit. Okay, so that's how you actually do it.
It means we are just comparing it historical trend
Yes.
to find out.
Yes.
So it was not like any absolute percentage to say that it is a greater spread or it is just a historical trend we were observing.
If you actually calculate the correlations between the two and the correlations are high, then you can come out with with an ideal spread, or which you can come out with an target spread that this is the normal spread that remains. Okay, and then see if the prices are moving up or down. This is how the algo trading happens. So algo trading actually defines the spread, and if the spread is higher or lower, it actually executes a strategy. So that is the algorithmic trading concept. So this can actually be created. You can actually create a model where you analyze historical prices, readjust it based on his on the say weather and other norms, seasonal norms, and then you come up with a with an ideal spread, and you say if the spread is for this month, if the spread is higher than this is the strategy. If it is lower than this is the strategy. So that can actually be statistically calculated, and that is for the researchers to do, that is for the analyst to do. In my PhD thesis, I had actually come up with an price prediction model based on the opening and the closing price. So intraday, what is this? What were the price movements? And then what was this the price relations with the overnight closing of spot, overnight closing of CBOT and say the Bursa Malaysia. So my PhD was into price prediction for futures trading of soybean oil, refined soybean oil. So these three products, if you actually look at, I developed a model where you can put in the opening price on the MCX platform, and you will get a say targeted range. If the opening price is yesterday's closing, sorry, and the three parameters, if you put those things, you'll get a range before the market opens. If the price opening price is above or below this range, then you can actually execute this strategy because this is going to correct. So this is what analysts do. They come up with and defining this ideal spread is the key. If you are able to crack this ideal spread calculation, then you can easily create a strategy.
Thank you, sir. Thank you.
So moving ahead, let's talk about the intercommodity spread, which is also called as the pair spread. Pair spread because there are pair of commodities which actually move in tandem. Like natural gas and crude oil always move in tandem. Gold and silver to a large extent move in tandem. Lead and zinc always move in tandem. In case of agriculture commodities, you would see there was a time period when the palm oil and the refined soybean oil moves in tandem. So there is a period when these commodities show a structured relationship. And if the structured relationship is disturbed, you have a spread opportunity. Okay, so look at this graph. This is the graph for lead and zinc on the 21st February expiry date for MCX. So this lead and the lead prices are depicted in blue and the zinc prices are depicted in red. So you can actually see the gap actually narrowing between them on between 26th of October and 2nd of November. So the gap has actually narrowed. Then the gap has expanded, and more or less it has remained to a certain level after 23rd of November. Okay, so that is the ideal spread. But on the October, on the 26th of October, the prices have actually given you a spread opportunity. And let's see how does this work. So you enter into a sell, because you can see the gap actually on 29th of October narrowing. This is because either the lead prices are overpriced, they have gone up, or the zinc prices have gone down. Now, in the hindsight, you know that the zinc prices actually had gone down, but on that day you don't know. So what you do, you sell the lead futures and buy the zinc futures, because either zinc is underpriced or lead is overpriced. Either of the two is true. So when you sell the lead and buy the zinc, and you wait for the prices to correct. On 28th of December, you see the prices actually getting corrected, and you then reverse your strategy. So what it does, it gives you a profit. It gives you, so your expectation on the lead future was wrong, because the prices were not were not overpriced. So they gave you a loss. But your expectation on the zinc futures was correct, where they were underpriced and they gave you a profit. So net profit of 37.50 was made on this transaction. Okay, so these are based on the live market prices, or the real market prices, how you can actually trade into spread. So when you actually, now the question, the same thing can be plotted with the graphs for two different expiry dates of the same commodity. Crude oil prices, you price, and the moment you see this gap closing, you say there's an opportunity. Now, of course, before getting into the live market, a lot of research has to be done. So as a researcher, what I used to do was, whenever I see a market opportunity, this thing, I would then execute a strategy on paper, put it, and then wait for the markets to actually give me the prices. That is validation. So maybe it's a month's time, I come out and then I realize that yes, this gap is working. And then you actually have historical evidences or empirical evidences to actually back up your spread. And then you come up with the spread strategy, transact. Okay, so this is how you actually execute the intercommodity spread. Now let's look at the intermarket spread. Same commodity, same expiry, two different markets. So intermarket spread is, this is the graph for MCX gold mini contract expiring March 21st, and NSE gold mini contract the same expiry date, March 21st contracts on the same commodity, same gold mini, same parameters, everything same, only the exchanges are different, the markets are different. So you can see if they are the same, then they should be very close to each other, but they are not. Between 15th of December or 17th of December till 4th of January, or maybe 31st of December, 29th of December, you can see there is a huge gap between the two. And that is the time when the spread opportunity exists. So what I do, on 17th of December, I see this spread actually widening. So I realize that this is either, and on that day, I find the NSE market to be lower than the MCX market. So I realized that either MCX is overpriced or NSE is underpriced, because this should be very close to each other. This is not the right this is not the right relationship. So what I do, I go long on NSE gold and I go short on MCX gold, because either MCX is overpriced or NSE is underpriced. Either MCX has gone above the bar or NSE has fallen below the bar. I don't know why, but I execute a strategy in which both ends I cover. If NSE is underpriced, I buy it. If MCX is overpriced, I sell it. And then I wait for the prices to correct. As I said, on 5th of January, these prices correct. I can see the gap actually between the two becoming very, very small, just where it was about 300 or 400, say 450 something on 17th of December. This has come down to less than say 60 on the 5th of January. So I reverse my strategy. I know that the prices have now corrected and I need to exit. So what I do, I exit by getting a reverse position. So in that case, what happens? Now I realize that the NSE prices, the underpricing of NSE was correct, And because of that, I make a higher profit on NSE prices. 1409 I make on NSE, 1126 I lose on MCX. I get a net profit of 823. So that's a spread strategy. The spread has given me 823 of profit. Okay. So at this point of time, now one might always argue and say that if I knew NSE was underpriced, then why do I actually get into MCX? Why don't I just go on NSE? But at that point of view, you don't know. Hindsight, you come to know. But on that day, you don't know what exactly is the reason why this relationship is disturbed. Is it because of NSE underpriced or MCX overpriced? You don't know. So you enter into both markets. You know that the direction of the mispriced market would be higher than the, or the benefit in the mispriced market would be higher than the benefit in the other market, loss in the other market, and that is what you play on. And that is how you make profit. Okay, so this is an example of an inter-market spread.
Sir, can we say this inter-market spread is a type of arbitrage strategy?
It can be considered as an arbitrage strategy. It is actually, in the traders' language, it is called as the market arbitrage. They call it arbitrage. It is actually in two different markets at the same point of time opportunity existing. So you can call it as an arbitrage market as well. Arbitrage, normally, when you talk about arbitrage with using futures, you talk about spot and future, separate transactions in spot and future, and that is why you call it a little bit different. And what does arbitrage strategy mean? In case of arbitrage strategy, cash and carry arbitrage is there, and reverse cash and carry arbitrage is there. So cash and carry arbitrage is basically when you buy in cash and carry in future. So if the price of the future is higher than the spot plus cost of carry, you get into cash and carry. So you buy, hold the stock, and sell futures. So you buy the stock, sell the futures contract in cash and carry. Reverse cash and carry, you sell this physical market, save on your cost of carry, and then buy back in future. Reverse cash and carry is a lot of time used by the jewelers who have huge quantity of gold. So what they do, they sell it in the physical market, save on the vault, on the interest rate and the vault charges and everything, and buy back from the futures, so that their ultimate purchase price is reduced. So that is reverse cash and carry. Who are the participants? There are financiers and arbitrageurs, and they want to earn opportunity between spot and future prices. So when does cash and carry arbitrage opportunity come? When the future price at say at an expiry date is higher than the spot price plus cost of carry. That is when the arbitrage in cash and carry happens. And reverse cash and carry happens when the future price is lower than the spot plus cost of carry. So that's how the arbitrage opportunities come in. Okay. So I think with that, I conclude my discussion on the spread and the strategies related to commodity derivatives. Let's open the forum for questions, because this has been a more say advanced concepts. It would take a little bit of time for you to actually absorb and practice it in the market, if I call it. But definitely, if you actually start following these strategies and start actually creating, say, maybe if it is say a spreadsheet, putting in prices and everything, we can actually create these strategies. So any questions that you have are most welcome now.
Participants have any kind of queries related with both the sessions, please, you may ask.
Sir,
Yes.
just a question.
Yeah.
Sir, you have in the spread strategies, you have made us identify the entry point.
Yeah.
And to enter, but then how to identify the exit point? Means, is there any particular way out?
See, when you actually look at the spread, you have to, once you get into the spread strategy, you have to on a daily basis keep monitoring the spread. On the day when you realize that the spread has now normalized, that is the time when you actually exit the spread strategy.
So we have to continuously monitor the.
Yes.
Yeah. Okay.
Hello, sir.
Yes.
Sir, I have one question, and that is, as you have said that in case of future trading, we have to maintain a margin call amount and a mark-to-market amount.
Yes.
So on the date of expiry, how these two are adjusted along with the final payment?
Yes. So what happens on the final day? There can be either say physical settlement or a financial settlement. A financial settlement is undertaken just like any other daily settlements. Whatever is the closing price, based on the closing price, your net position or whatever is your net open position, the outstanding contract say amounts, based on that your payoffs are calculated for that day, and then the closure happens and your position are squared off. Okay. Now that is in case of financial settlement, but if it is a physical settlement, then you have to go into the physical delivery of the goods and purchase of the product. So there is a concept of delivery period margin. So commodities which go into physical settlement, the exchange would ask you to deposit 100% of the value as physical period delivery margin. So if suppose your margin was 8%, you're buying chana, now you would be asked to deposit another 92% of the transaction value, and that would be paid, that would be given to the seller, and the commodity warehouse receipt would be transferred in your name. So that is how it is settled in case of physical settlement say contracts, or where there is compulsory delivery.
Okay, sir. And sir, in case of financial settlement, like in case of index future, there is no cost of carry or convenience yields. Then why is the difference between the spot price and future price?
So there is a cost of carry. Cost of carry is based on the what do you call, the interest rates. Because of the interest rates and the investment cost, because index futures are investment asset, there is an investment cost associated to it. And because of that, the futures prices are actually different than the spot prices, and that is the interest rates based on which the future prices are defined in index futures. Now, when you actually look at the convenience yield may actually be say dependent on multiple factors, which is the anticipation of the market, the future, because in index futures which are related to equity, there are whole different dynamics that play out. And that is why the convenience yield is differently calculated. And that is why you see this difference in prices.
Okay, sir. Okay. Thank you, sir.
Yes.
Any more questions from participants? I guess, sir, you have explained the entire concept of commodity derivatives so wonderfully. Our doubts are already solved. So thank you so much, sir. Thank you so much. And on this note, I would like to invite Dr. Mansi Kukreja to present the vote of thanks to our resource person, and as well as represent the research. Mansi, over to you.
Thank you, Dipti ma'am. Thank you so much. Thank you, sir, for such a wonderful session and informative session. You really justified your topic, commodity derivative analysis using real-time data. In the first session, you have covered the introduction of derivative and its structure, mechanism, basis of futures, commodity derivatives, derivative contract, underlying variables like equity, commodity, interest rate, swap, foreign exchange, weather indexes, swap, and you have also given us a brief introduction of long and short position, offsetting positions, how the participants work in the foreign exchange markets, and investment assets, consumption asset, and different models, that compounding and cost of carry models, how we are going to use them. And you have covered a lot of things in the first session. Then again, in the second session, you go with the elaborate version of it, and with the contango market strategies, backward market strategy, holding of stocks, hedging strategy, arbitrages, speculating strategies, and all that you have covered lot of things, sir. It was really a wonderful session by you, and thank you so much. Thank you so much, sir. And really, sir, we are waiting for phase 3 also for you, sir.
Thank you.
So
Thank
much.
you very much. Thank you.
Hello, sir. This is Rajat. I have one request.
Yes, Rajat.
Sir, is there any copy of your thesis available at online platform?
No, not yet, because I have not put it on online. But there's a book that I have written on
Yes, sir,
commodity derivatives, which is available with Excel Publishing. And
Yes, sir.
that covers a lot of details that I actually did in the research study as well, and multiple other things as well. A lot of practical experience, say calculations that we have put in, a lot of details about spreads and also that you can look at.
Okay, sir. Thank you, sir.
Thank you.
Can you share the name of your book and the publication?
Yes. Can I put it in the chat or?
Yeah, sure.
Yeah.
Yes.
So it's Commodity Markets and Derivatives, published by Excel Publishing House.
Okay, thank you so much. And Divya madam is asking that
Yeah.
How early we can get your PPT, whatever.
I think today itself I'll send you the PPT through
Yes, sir.
email, and then you can circulate it to the participants.
Yes, we will share with the participants. And
Sure,
once
sure.
again, sir, thank you so much for sharing your deepest insight for commodity derivatives and stock market on whole. So it's like our privilege to have you as a resource person for this training program. Thank you so much, sir.
Thank you, ma'am.
Thank you.
Thank
Thank
you all
you
of you
so
for
much,
your
and
time.
looking forward to see you in coming phases also.
Sure.
Thank you.
Thank you.
Thank you,
Thank
sir.
you,
Have a
sir.
nice day. Thank you. Bye.
And participants, so we are taking a lunch break of 45 to 50 minutes from now, and we will join back at 2:30 p.m. for in continuation with the yesterday's Mr. Pranvesh Chatterjee's session, which was continuing from yesterday. That was on portfolio management using R. So we will meet at 2:30 p.m. sharp. See you then. Thank you so much. And make sure you fill the feedback form on time, right? So because the link will get closed after half an hour. So thank you so much, and see you after 1 hour. Yes, it's a like a gentle reminder. So participants, please join like 5 minutes prior to the time. So we'll meet together like at around 2:25 p.m. so that we can begin the session sharp.